Well, super excited to kick off day 2 here. Um, yeah, so super excited today, and I really hope if you were there, you got a lot of the value from yesterday. If not, like I said, we could definitely send over the recording over to you. As I mentioned yesterday as well, uh, really one of the benefits of us being live and the benefits of hundreds of you being part of this as well is that the hope is that we can all collaborate together, and even within the chat, just please sharing. If we're covering a certain topic, what has worked well for you, because there might be other issues or bottlenecks that other people are facing here that you maybe already solved, right? So, and I think if we really combined all of the knowledge and all of the heartache and all of those lessons learned here together, I think we can all, really have a profitable and an exciting 2026. I'm super excited about 2026, and I had also shared the schedule of the for the day as well for the speakers. It's going to be hard to top yesterday in regards to a lot of that value and different stuff being shared, but super excited to get into it. And I have here along with me Carla Policastro. She's one of the CPAs here at the firm as well. Also my wife, and we run Cycle CPA. We do everything from bookkeeping to fractional CFO and tax services virtually. So we work with companies all throughout the country. Specifically in the green industry, and super excited to get started here.
Yeah, thank you all for joining today. I'm excited to start day 2 of building your budget and planning for 2026. Let's get it started.
So here's the schedule. Today we're really going to go through everything from, what is the approach when it comes to recouping materials in your estimating and pricing. We're going to go through how to build bonus plans and incentives plans with your team. We're going to touch on deeper dives into marketing as well in regard to insurance, and can we look at some of the financial considerations behind electric equipment, looking at software expense, recruiting and onboarding. Is leasing a good option for your team when it comes to the different trucks and equipment? So really taking a deep dive into some of these topics. And when it comes to looking at your budget, ultimately the goal, right, is hopefully you have financials to look back at from 2025. If you don't, reach out to an accountant. That's something we can also help with as well in regard to cleaning up your books and accounting. Because ultimately you want to be able to see how did the company perform, right? And then it comes down to what is that plan for 2026? And oftentimes people might look at certain expenses and you might look at the company and look at profitability, and your gut feeling might be, okay, maybe we actually need to cut costs in certain areas to hit the profitability goal for next year. However, that isn't the only solution. Oftentimes, what is actually happening is you might just not be at capacity with that given crew or that given employee or even that given piece of equipment or the truck that you have and those fixed assets. So also thinking in terms of that too. Also, it could be certain efficiency opportunities, right? So that's where you can really look deep into the P&L, similar to kind of what we're doing yesterday and today, and really diagnosing whether you're comparing it to industry averages or you're seeing, okay, what is that rate of change? Why did my material costs go from 8% last year to 12% of revenue? Why did my overhead go from 30% to 36% of total revenue? Looking at those things and figuring out, okay, what for each one of those line items, how can we optimize that and really improve it when it comes to some of those efficiency opportunities? And then the other aspect as well, and we're going to have the speakers cover this too today, and it's, you can be very specific and you can get very granular into looking at certain efficiencies, being very on top of your team, holding people accountable, making sure that you're utilizing the right equipment. But at the end of the day, if your pricing structure is off, then you're going to put yourself in a position where it's impossible to succeed, and it's not going to be easy to make a profit. So oftentimes, as you're thinking more from a bird's eye view and you're looking at your plan for 2026, oftentimes it can fall into one of these buckets. And with that, we're excited to jump into really the first speaker for today, and it's Michael Pletz. Now, Michael's going to go over budgeting for materials and overhead recovery as well, which is a great way to kick us off here, because it's something that we see is one of the most common things that companies are not doing well, right? And again, this is Michael. He's the owner of Ever After Landscaping, the creator of Headquarters Software, and the founder of How to Hardscape, an educational platform featuring articles, visual content, and one of the industry's most respected podcasts. Michael brings deep expertise in budgeting, materials, planning, overhead recovery, and he helps contractors build pricing models. And just the overall resources that Michael helps with is amazing. I could be biased, but his podcast is phenomenal, and his content as well. So if you're not following him on social media, definitely do so at How to Hardscape. Super excited to get into this, and we'll let Michael take it from here.
Yeah, thank you, Michael.
What's happening, hardscapers or green industry professionals? My name is Mike Pletz. I am the owner and operator of a small hardscape company in the Toronto area, and I am also the voice behind How to Hardscape, the podcast, website, as well as all these other things that we've got going on. I am a hardscaper as well, and thank you to Cycle CPA for having me for this. I wanted to talk about budgeting for materials. I do have some strong opinions on this, and it really just comes down to talking about overhead recovery method for budgeting for materials for your season. So personally, I don't budget for what I'm going to spend on materials. Materials are just a byproduct of completing a project, a cost of sale, cost of goods sold for that project. And I don't even mark up my materials per se. I do charge my clients for retail pricing, and that is essentially my markup, that contractor price that I pay versus what we charge our clients for retail. I justify that because we would not be able to get our clients, or our clients would not be able to get our contractor pricing. That's just based off a relationship that we've built with our supplier. And I get a lot of contractors asking me, or I see it in groups, hey, what are you marking up your materials by? It's the wrong question to ask, because everybody's going to be recovering their overhead very differently, or not even knowing how to recover their overhead. There's so much context that goes behind asking a question like that. So I'm going to try to break this down as to how I budget for materials, how I think about recovering my overhead, to help break this down step by step. So first and foremost, I recover my overhead by a labor rate recovery method. So that just means that I'm recovering all of my overhead through my labor. I'm not relying on a markup of my materials to recover overhead. I'm not relying on a markup of subcontractors to recover my overhead, or I'm not recovering my overhead through equipment. It's strictly labor rate. So what that means is at the beginning of my season, I will set the amount of hours that I have in my season to recover my overhead. And basically, I look at last year and I carry forward that number plus or minus. So I usually work about 36 weeks in a season, or a year for us, minus winter for us. So we don't work during the winter. And then we have 5 working days and then 8 hours per day. You multiply all that out, we're usually around about 1,600 hours per season that we are working. Now, to recover our overhead, what we do is when we're quoting a project, and let's say a project is going to take 160 hours, that's 10% of our season. So we're going to add 10% of our overhead that we've budgeted for to our project, add our materials and labor costs to that, and then add a net profit on top of that. And that's how we recover our overhead, strictly through labor. Now, you can say I have one crew, 1,600 hours, 100% of my overhead is going to be recovered by that one crew. Very easy. Or you can split it up by two crews. 50% of my overhead is going to be recovered by one crew. 50% of my overhead is going to be recovered by that other crew. Or what I like to say is once you're at that 2 crew, 3 crew stage where your crews might have 3 people, then 2 people, then another 3 people and another crew, you're likely wanting to recover overhead by employees. So if you have 5 employees, 20% of overhead, 20% of overhead, 20% of, and so on and so forth there. So that's the basis of labor rate recovery method. The reason why I like this is we're setting a break even of what we need to make in our business to be profitable, and then adding that net profit on top for what the business will make. And that's important. That net profit is what the business makes, because when you're adding in your owner's salary, you are an employee of the business. So it's very important to add a fair market value of you as the owner into your budget as a non-labor producing employee, so that you are recovering your salary and then adding a net profit for every project for this. Now, this method makes things really straightforward and very easy to follow, especially if you're a business that's doing many different types of services and you don't have different divisions distinguishing those services. So just to give you an example of my business, we are a design build company that also will do lift and relay. So picking up pavers, putting them back down, re-leveling them. We'll also do drainage as well. Those are 3 really distinct types of services that we don't have different divisions for, meaning we don't have specific crews for each of these different services. And why that's important and why that applies to setting a budget for your materials is that we don't know exactly how much design build projects we're going to sign up in a year, how many drainage projects we're going to sign up in a year, and how many lift and relay projects we're going to sign up in a year. So if I was relying on my materials to recover my overhead, and when design build takes up anywhere from 25% to 33% of my materials in design build, and I was to sign up an entire season of lift and relay work where the materials are anywhere from 5% to 10%, I'm missing out on an entire amount of overhead, a huge chunk of my overhead recovery by not pricing in and scheduling design build projects. So this is why materials don't even apply to me for actually budgeting for the year. Now, it's nice to have. It's nice to look at my numbers from last year and see where I might be at this year. But really, those materials just carry forward to the revenue, the sales goal. And that number is a vanity metric. I just want to know that I'm profitable. I want to know that I am making a net profit at the end of the day. Still, really good picture to have, and have a breakdown of your different services and the percentages of materials that are going to these different services, and create benchmarks in the future to have that data, so that when you do create divisions for these different distinct services, if you do in the future, you have those benchmarks to go off of that you can create sales goals from. Now, where it does become crucial to create a budget of your materials for the year is when you're using a multiple overhead recovery system. This is multiple overhead recovery, where you're going to actually be creating a markup of materials, labor, subcontractors, sometimes even equipment to recover your overhead. So basically, you're going to take your materials, you're going to take your labor, you're going to take your equipment, sometimes subcontractors as well, and you're going to create a target for each of these as to what they're going to cost you. And I'm going to use very simple numbers here. So I'm going to say materials, $10 for the year. Labor, $10. So they're equal there. And I want to create a sales goal for the year of $40. So what that means here is I've got $20 I need to actually mark up my materials and labor for to hit my sales goal, which would include my profit for this. Once again, very simple numbers for the year. So in order to hit this sales goal, I would have to, let's say, mark up my materials by 100%. And that would be an additional $10, and mark up my labor by 100%. Once again, an additional $10 to that to equal our sales goal of $40. Now this would be a single overhead recovery system where we just add a flat markup between materials, labor, subcontractors, equipment to recover our $40 sales goal. But in a multiple overhead recovery system, we would say that, you know what, materials don't take a whole lot of our management to get to. What really takes up the bulk of our management is our labor cost. Because we have to schedule them, we have to handhold them and get them the design and make sure that they're doing that in the field and so on and so forth. There's a lot more management cost that goes into labor versus placing an order for materials, getting them delivered, sometimes picking them up, whatever that might be. So you might be saying, you know what, once again, simple numbers. So I'm going to mark up my materials by 10% instead. That's going to give me an additional $1 towards our $40 sales goal. And now our labor, instead of 100%, now needs to be marked up more than 100% to be able to recover an additional $19 to then hit our sales goal of $40. So it's that juggling of multiple overhead recovery to be able to mark up different rates of percentages to recover your actual sales goal, which makes it incredibly important to know what you're budgeting your materials, what your budget for the materials of that year is, so that you can apply the correct percentage markup to recover what you're hoping for your sales goal. So the thing that I like about multiple overhead recovery is that you're diversifying how you're going to be recovering your overhead. Where, you know what, if you're a little bit off on materials, you might make that up in labor. If you're a little bit off in labor, you might make that up in actual materials. But once again, I still like the labor rate recovery method because I still do have that slight markup of materials by charging my clients retail pricing on materials. And then I just want to make sure that I'm hitting those labor hours on every project to be able to recover my overhead through that labor. But once again, that's me personally in the way that I operate my business. And all this is to help you understand when you hear people talk about labor rate recovery method, multiple overhead recovery method, whether or not they're marking up their materials, what they're marking up their materials by. It's really important not to listen to other people's numbers because they might be operating their business very differently than what you are and what you're planning to do and how you're recovering overhead and so on and so forth. It's really important to be able to talk to somebody like Cycle CPA. Quick little plug for them, because they will be able to point you in the right direction of what is best for your business. I know that when I do start to branch off and have a specific design build crew where we're actually doing just design build with that crew as a division, and then I have another crew that's specifically only doing lift and relay work, it might be nice to actually have a multiple overhead recovery to be able to diversify how we're recovering our overhead and have really specific sales goals that we're trying to hit. So overall revenue of the business. But if every project is going to be slightly different between the percentages of materials, labor, subcontractors, even equipment that you're using on site, that's why I really like the labor rate recovery method, because then we don't have to set a budget for our materials. All I'm doing is just creating a break even. This is what the job is going to cost based on the materials that we have on the project, based on the labor that I'm budgeting the project for, and then I can add my net profit on top of that. I don't have to set a sales goal at the beginning of the year. I can just say, hey, if we sign up an entire year of lift and relay work, that is great. I don't have to start sweating on the material budget that I created at the beginning of the year and say, you know what, we need more design build work. I need to say no to these lift and relay projects that are coming in, and I need to just focus on getting more design build work because we need that markup on our materials to be able to recover our overhead. I've talked to many different contractors who, for example, were just getting into pools, and they had budgeted at the beginning of the year that they were going to install 5 pools for the year, and they ended up installing no pools, and the markup on their pools were meant to recover their overhead, and in that case they actually got to the end of the year and they didn't make the profit that they wanted to at the end of the year. So this is where I'm saying that it's a lot more flexible to be able to recover your overhead 100% through labor, so that you don't have to set those budgeted amounts for your materials. You can be a lot more flexible in that way, but on the other hand, multiple overhead recovery system is really good for diversifying how you're recovering your overhead, as long as you are able to hit those markers in terms of materials, labor, subcontractors, and sometimes equipment. Now, if you do want to create a budget for your sales goal with your materials, it's always nice to have last year's data, create a point in which you want to grow to, and that percentage difference is what you would just add to your materials. Fairly kind of simplified version of being able to do that. But once again, coming back to that swimming pool example, if you're adding a whole nother type of service or product to your business, that does get really complicated, because what if you set that sales goal and you don't actually end up installing any swimming pools, but at the end of the day, you're still profitable. At the end of the day, that profit is what we are looking for in our business as business owners. We're not looking for that vanity metric of actual revenue, sales. We want to know that with what we're pricing, we are hitting our profit. But if our services are streamlined, if we're doing the exact same thing every single project, and last year we did $100,000 worth of materials, and this year we want to grow 50%, well, you're likely going to be at $150,000 in materials if you're going to continue to do the same thing, not adding swimming pools to it. Hey, I hope this has helped you in some way and at least opens up a conversation. I'm more than happy to talk to anybody and everybody at How to Hardscape, wherever you want to message me. And thank you so much, Cycle CPA, for having me on.
Thank you, Mike. Well, we really appreciate those awesome tips there, and I think it's especially evident for as companies scale up, because when you really start to prioritize some of this stuff, you know, and you go from $500,000 to $1 million or a couple million in revenue and grow from there, these things start to go from maybe a couple $1,000s on the line to, you know, tens of thousands of dollars. So really appreciate you diving in here, Michael. And we also dropped the How to Hardscape website in the chat. And if you thought that was a lot, there's even more resources, an endless amount of resources with everything that Mike does around How to Hardscape. And, you know, so thank you for everything you do for the industry, Mike. And that's phenomenal stuff. And now super excited to introduce our next speaker, Ryan Markowitz. He's going to cover building blocks of an effective bonus plan. Ryan is another titan of the industry, someone that has really designed a company to truly operate in a way where his whole team really has kind of like an entrepreneurial mindset, you know, and they really take accountability, and it doesn't happen on accident. You know, Ryan has built the processes around that, and it's phenomenal to see. And you know, I know Ryan even spends time down in Mexico for parts of the year. So listen, you know, for some of you that are in a position where you're maybe even borderline burnt out, spending half the year in Mexico could seem like a very big thing to get to, but it's about starting small, you know, and that's what I recommend, you know, as Ryan will begin here shortly, really kind of focus in and see, okay, what are aspects of this that I can implement within my company? Because again, you know, our goal, you know, Carla and I's goal here is we wanted to bring people in that have done things, in great ways to scale their own companies. And we want to make sure that everyone has access to that kind of stuff. So super excited to have Ryan here. And Ryan Markowicz is the founder of R-Mark Consulting. He's also a Leanscaper certified advisor and specializes in open book management. With years of coaching experience and over 30 years as a founder of Creative Roots Landscaping, Ryan understands both the operational and the culture challenges owners face. His expertise spans design, install, maintenance, team development, and community engagement. Ryan now helps businesses increase profits, reduce chaos, and create transparent, accountable team environments that support long-term success. So super excited to have you join us, Ryan, and we'll let him kick it off from here.
Hello, everybody. Welcome to this amazing event that Cycle CPA is putting on. I want to thank Carla and Joe for inviting me to talk a bit about things that I'm passionate about, the numbers. I love the fact that this event is providing education as to the numbers and how they affect the outcome, because realistically, the numbers are simply stories about people and what's being done. And if you really want to get your people behind the outcomes of the company, net profit, gross margin, cash flow, all that stuff, they're going to have a deeper understanding of it. And that starts with you if you're an owner or in management or leadership. But it also is really powerful when you drive it down to the front line, because realistically, those are the people that make or break your business. Those are the people that are out there delivering every day on the services and products that you give customers. And if they don't understand the game they're in or how their actions affect the outcome, you could be in real trouble, in my opinion. And so the numbers are stories about people. And don't try to turn your people into accountants or bookkeepers. You leave that to the people at Cycle CPA. But do help them understand and gain clear line of sight to what's to be gained if they improve the results of what they're doing each day, and the company is simply healthier. So I've been asked again to talk about an annual bonus plan. We like to call it a profit gain share plan. And I just want to start, and I've made a few notes here, so I'm going to reference those, is that bonus plans alone don't drive improved performance. It's the people that drive the improved performance. And a bonus plan can help improve results, but only if people they clearly understand improvements and what's needed, and how they make a difference, and what they stand to gain. So think of your bonus plan as an accelerator. It will make the engine go faster, but it won't start the engine. Also, please keep in mind that bonus plans will not guarantee success, but it certainly changes behaviors and helps drive the results, provided people, again, they clearly believe in the goal, understand what improvements are needed and how they can make a difference, and again, what they stand to gain. And that's important. So this is something we do at Creative Roots and have for 20 years. It's called high involvement planning. So when we are building out sales plans or presenting the balance of the sales plan in an entire financial plan to the team, we want to make sure that people have the opportunity to shoot holes in it at every step of the planning stage, and that by the end of it, before it's set in place as a financial plan for the next year, that they have a clear understanding of what is trying to be attained, what the most critical numbers are on that financial plan, and how their role affects the outcome on each person. So again, if done wrong or incorrectly, I should say, bonus plans can hurt the company more than they can benefit. They can actually discourage and dissatisfy employees rather than promote something that should be fun and rewarding. So, and I would say they're probably the most often misused management tool in the toolbox. So I'll talk about some common but dangerous bonus plans. One, they're discretionary. Think discretionary. Think the Santa bonus. Think Chevy Chase and Christmas Vacation. If you've seen that show, if you haven't, well, we're in the season, so make sure you make sure you watch that. They're too complex. Think the rocket science bonus. It's confusing. People don't understand. It's not being communicated. Am I getting a bonus? I'm not getting a bonus. What am I getting measured on? Or they create silos. There's another type of bonus. They create silos where it gets people competing against each other. And that's not healthy in a team environment as far as I'm concerned. Think the no buy-in on the goal bonus or maybe the bonus, the lotto bonus, let's call it the lotto bonus, where you're just buying it because you think you might win. You're not really bought in the understanding of how you could win, other than it might be luck. We might be lucky, we might not. Think no communication. What bonus? I didn't know there was a bonus, and believe it or not, as crazy as that sounds, that happens. And or the owner just feels good at the Christmas party and decides to hand out $100 or $300 or $1,000 or $5,000, but nobody actually understands what's going on with it. So I want to talk a bit about the building blocks of an effective bonus plan, and because it really is simple once you understand how to build it, to build a bonus plan that's equitable, not equal, but equitable amongst the people. And so number one is you want to rally people around a common goal, ensure that everybody remains focused on the same goals, and we want people to play together as a team, like to pull them in the same direction, so to speak. You want to reinforce cooperation and encourage collective efforts to make the business stronger. So we're always choosing something that is going to improve the company in that 1 year, because this is an annual bonus plan, relative to what it needs to improve on for the longer term of the vision or the goals of the company. And also, we either win together or we don't win at all. That's important to me. If people are superstars, if they are doing more than the others, then their base compensation, in my opinion, should be moved accordingly. But when we are talking about a bonus plan, we want to make sure that everyone's passing the ball to each other, communicating, and are aimed at the same goalposts. But with the education that you're able to give people by having them involved in creating it at some level, you're able to arm them with the knowledge to deal with the unfolding drama that happens every day in business, every day in life. So knowledge is power, so to speak. So let's go to number two, building blocks of an effective bonus plan. Ensure long-term security first for the company. Financial security, that is. So we like to call it profit gain share, because if we call it just profit share, that kind of speaks to the thought that once the company is profitable, we're going to start sharing. And we all know that the financial needs of the company do not end at the end of the profit and loss statement. That's the operating expenses. There are other expenses that reside on the balance sheet and other things. So change in accounts receivable, the add back of depreciation, because it's not an actual expense, but it is a future cash requirement, a potential change in inventory over a year end, planned capital expenditures, dividends or return on investment, or how about taxes? You could give away all your profit at the end of the year for operating profit and not have enough to pay all these things. And so after those things are considered, we have created what's called a threshold. And then above that threshold, we create Creative Roots 10 layers of profit sharing, which give each employee that is paid hourly the opportunity to earn up to 15% of their gross earnings. So our plan normally sits in that level 2 or 3, and that would create an early win. Then we have the totally achievable ones from levels 4 to 8, and then we have the stretch goals 9 and 10. If we've gotten to that much profit, the people deserve to win. That is like the players have helped win the Stanley Cup, so to speak. And so over and above that threshold, you really want to provide a significant portion of the gain into the profit sharing pool, and that can be altered. But as a rule of thumb, usually it's 50% above that gain. 50% goes to the company, 50% goes into the profit sharing potential pool. I hope that's not too confusing. Third one, give people a chance to win early and win often. We need to reward behaviors in real time, or as close to real time as possible, because we still have to close the books and all that stuff on a monthly basis. So we like to break down our 100% potential to share and profit into quarters. And so we would put 10% of that eligibility into the first quarter, 20% into the second, 30 into the third, and 40 into the fourth. So that if there was no profit to be shared in the first quarter, it's not you've lost that eligibility, you just simply push that forward. So in the second quarter, you're able to earn 30% if things go well. If you don't make anything in the third quarter, in the second quarter, you can push it to the third. So you take that 10 and 20, add it on to the 30 in the third, and you've got 60% chance to earn 60% of the 100% total. I know that might sound confusing, but just think of a game again. You could be down in the first quarter, you could be down in the second quarter. That doesn't mean that you can't win in the third or win in the fourth. And we stage it 10% at the beginning to 40% at the end, so that the best players stay in the game. Nothing speaks to understanding the game as much as pushing till the end of the game. So the best gain is given when people finish the game as strong as they can. And it also doesn't put the company in a poor position if, for instance, we have shared the profit equally over each quarter, and by the end of the third quarter, you've paid out 75% of the potential and then tank in the fourth. So that's maybe complicated, but it does work. And I'm happy to explain that a little bit more to anybody who's interested. Super important that we use the bonus plan to teach people about the business, and because realistically, they can be the most effective education tool we have. Too often, employees don't understand the financial impact of their decisions or actions. We know that. Worse yet, non-decisions or non-actions are not related. The people just don't connect what they're not doing to the outcome as well. They just think, I'm working hard, I deserve a bonus. So the education component's really big, and it also educates people on what's critical to the company year over year. And as we know, that changes. If you're striving for growth or you have high debt, your critical number might be principal pay down or cash savings to buy a new facility or invest back into the people. Well, if you're investing everything back into the people, it's going to be really hard to keep profit, because the profit to share, I should say, because the profit is being shared through the reinvestment. People have to be on board for this, because if they don't buy in, they won't execute. And if they don't understand, they won't buy in. Lastly, I want to talk about communication. This is the mainstay for everything you're going to do. And poor communication is probably by far the most common reason that profit sharing or bonus programs fail. And it just doesn't matter how brilliant you have been, or no matter how well you have selected your goals, no matter how carefully you've structured the payout, your plan simply won't motivate or engage people if they don't get it. And if they can't get it or even follow what's going on in real time. So if you want to, let me check my last one here. Bonus plans will succeed. Yeah, exactly. So lastly here, this is human nature. Always celebrate the win and recognize the players. Your ability to pay out profit sharing based on a gain above a threshold that already considers the health of the company should be rewarded and recognized. If people are pushing beyond what constitutes a good solid effort, and that solid effort builds the threshold, if they're able to go over and above that, you should be proud of them. And part of that is by sharing in the rewards with the team. And I just think that is probably one of the most valuable tools for accomplishing company goals and improving the employees' quality of life, is the act of recognition and identifying and acknowledging performance of the team, and for those who have gone over and above the expectations. So I hope that helps. I know it's a bit confusing potentially. I will tell you it's not confusing to me, because we've been doing it for 20 years and we have an actual process and system to implement a profit sharing program, a profit gain sharing program that actually works and motivates the people. At the same time, not causing any stress to the company's health. And it also provides for long-term sustainable growth. I hope that helps, and I appreciate you listening. Look forward to hearing some of your questions.
Awesome. Thank you so much, Ryan. Great stuff. And Ryan is available now for any questions as well in the chat. And for those that didn't see as well, he has an event coming up in Mexico in February. So definitely sounds like a fun event. And I'm sure, Ryan can, a lot of what he covered today is just the tip of the iceberg. So whether it's at that event or reaching out to him, these are things that can really move the needle for a company, especially as you're looking to, have other people really take control in the company and, be able to build out those systems. And Ryan runs a phenomenal company. And like I said before, he also helps out companies now as well. So definitely reach out. But thank you very much, Ryan. We greatly appreciate you taking the time here. And the next speaker, and I think it's similar to bonuses as well, right? And different things when you think about your company from a longer term perspective. What are things you can do to ensure that you're hitting profitability, that everyone's rowing in the same direction? And as you start the company, when it comes to the marketing side, you might sometimes think that it comes down to, okay, we spend X on marketing, we need to get X in return that month, or you need to pay for leads, and I know there's a lot of those services now that are online, which listen, some of those have their purposes, but I think as companies progress, you start to see more and more that your brand in your community makes an enormous difference. And I think a key example of this as well is when a company is first starting out, you could spend 5, 10, even 15% on marketing costs. But as the company gets larger, there's a reason that typically you may not even have to spend that much on marketing, because you have the brand, because people know your company in the community. Now, how can you get to that point where you're able to build that brand in a shorter amount of time? And that's why we have our next speaker here, Adam Fullerton, and he's going to cover budgeting for a high impact brand in your 2026 plan. And Adam is the co-founder of Branded Bull, a branding and marketing agency dedicated exclusively to green industry contractors. He and his team help 300 plus lawn care and landscaping businesses build high-performing websites, improve local SEO, strengthen their branding, and run profitable paid search campaigns. Adam also hosts the Branded Bull podcast, where he teaches practical, no-fluff marketing strategies for contractors looking to stand out and win more work. So super excited to dive in here. Branding is one of my favorite topics as well, but we'll let Adam take it from here.
Hey guys, Adam Fullerton here with Branded Bull. Pleasure to meet you, and thank you for joining in. And today we're going to be talking about budgeting for a high impact brand in 2026. Before we jump into a few slides we have prepared for you guys today, just want to make sure you know who we are. And if you haven't heard about us before, I welcome you to visit us at brandedbull.com, and we're all about helping green industry businesses stand out, get found, and win more work. So if you're a lawn care business, a landscaping business, a snow removal business, and you're looking for a partner when it comes to your marketing and advertising that specializes in the green industry, we've got you covered with things like simple to understand, straightforward packages and prices for things like websites, local SEO, Google search ads, and of course, logo and branding, which we'll talk more about today. So with that said, let's jump into things for the next few minutes. What we're going to do is we're going to talk about branding and budgeting and why branding belongs in your 2026 plan. So if you're not familiar with branding, it is ultimately the perception that you are creating in the minds of your customers. And so you want to understand that branding is about trust, it's about building credibility, and it's about creating recognition and standing out from the competition, like I said. It ultimately can impact your ability to get leads, it can impact your ability to charge certain rates, and ultimately it can impact your ability to attract the right type of clientele. And if commercial clients is who you're after, well, then you need to look like a company that can handle commercial customers. Ultimately, consistency across all your trucks, your uniforms, and your websites is a must-have. It is about consistency. It is about cohesion. It is making sure that everything looks the same or very similar so that you're building the awareness and the recognition, like I mentioned. And this can help you drive higher value customers to the business, and ultimately this is what sets you up for long-term growth from a perception standpoint. It's about making sure that your business looks the part, has the appropriate suit and tie attire on when trying to attract the right type of clientele. Again, this is about first impressions, and branding shapes buyer trust at the end of the day. We all judge companies based on their visuals that we see. Now, we can't always call and pick up the phone and talk to the owner of a business right then and there. So we rely on what we know. We look at trust factors, and that might be reviews, but also one's logo, one's branding, and the presentation of the company. Now, we all can't, again, pick up the phone and sell someone on who we are as a business and make sure that they know everything about us and all the details and our quality work and all those great things. We have to let customers rely a little bit on our branding to tell some of the story, or at least get them past the first layer of defense in their minds. Because at the end of the day, all this is trying to tell customers who we are, what we do, and where we service, so that they can feel comfortable in contacting us and hiring us as service providers. So you want to make sure that you have your logos, your trucks, your uniforms, and all these things need to be buttoned up, because these all create first impressions when you, again, are not there to pick up the phone and tell people exactly who you are and what you do and how you're the best. Ultimately, too, your website is a big part of this. That's another service that we offer. I won't go into that right now, but websites have to reflect the professionalism that you offer as a business. And ultimately, again, consistency is what builds recognition. You want consistency in all of your marketing, all of your advertising, all of your branding, so that you're reinforcing the same message or the same kind of business that you are. And so if we all see the lawn care company in the area that has that beautiful bright orange branding, well, there you go. We all now put that in our minds as potential customers and say, I've seen them around before. I've seen that branding. I've seen that color. So it creates that impression, and that helps people remember companies. And that's what all of this is about: standing out, getting found, and of course, winning more work by separating ourselves from what other companies are doing in the same markets that we're competing in. And like I said, clear branding does that. It sets you apart locally. Talking about revenue impact for just a moment, branding also helps you drive close rates. At the end of the day, professional branding is the first layer of defense. We all judge books by their covers, whether we're told not to or when we're told not to growing up. It is what it is. We all judge books by their covers. It's why covers exist. So professional branding will help you win more work because you are being judged. Your book, I should say, your business is being judged by the cover, and you want your cover to look very professional and to attract the right type of clients that you're after. Ultimately, too, you can always charge more if that's one of your goals, because if you're trying to look like a premium service provider, then you need to look like a premium service provider. And while you might have the best work out there, if your branding is not up to par and it doesn't make you look like a premium provider, well, it doesn't really matter because you won't get the customers and the clientele that you're after. But a very nice buttoned up presentation allows you to command a higher price, assuming your service actually follows through on being premium. Also, like I mentioned earlier, if you're looking for more commercial customers, branding is a massive piece of this, because when you look like a company that can handle commercial work, you obviously have a better propensity to have them call you or connect with you or actually consider hiring you. And so if you don't look the part, well, they're going on to the next guy in a matter of a split second, just like we all are in this day and age. So strong branding, it helps you convert faster, it helps you look the part, and it ultimately helps you stop spending as much money on marketing when your branding does more work for you. The better it works, the better the efficiency, the more effective it is. That means less wasted effort, less wasted marketing dollars, and ultimately helps you from a ROI standpoint. When it comes to budget, this is something that we're absolutely happy to share, as always, is that we have straightforward packages for our branding and logo services. So I encourage you to go to brandable.com. You can see visual examples of each of our packages in terms of what is included and who each package is recommended for. So if you're here today, though, very quickly, if you're 0 to 250, we have something called our starter package. If you're 250 to 500 in terms of revenue, you're a little bit bigger, we have a package for you. And then if you're 500 to a million or so, we have a third package for you. And I want you guys to remember that branding is a long-term investment. And so when you take these dollars, you don't immediately get a new logo and say, cool, all the leads are going to be flooding in. It doesn't work that way. This is setting you up towards long-term growth and long-term success. You are now able to put this logo or these colors or these standards on things like your logo, your truck, your shirts, your website, your flyers, your lawn signs, on any marketing you're doing in essence, and look the part and have that suit and tie on. So if you're looking for a specific type of package, we have it for you, I'm sure. And the good thing with us is that you can always upgrade to the next package if there's certain things you get in one package that you don't need right now, or you don't find the value in it right this moment. But when you're planning ahead for 2026 and trying to figure out what to budget, well, there's no guesswork when you work with us at Branded Bull. All of our prices and all of our packages are preset. So again, I encourage you, go to brandable.com, go to our pricing page, look at the examples, click on them, see the visual designs that we have made and what you get. And this is what you want to budget for based on your goals if branding is a priority and if standing out is one of your main objectives in 2026. When it comes to branding, I also want to mention that people just think it's a nice new logo and then I'm done, and that's great. It actually has a lot more involved, there's a lot more involved. You can now use your logo and branding to help you establish your identity. You can use it when you're doing a website refresh. You can put it on your trucks and your uniforms, like I mentioned, yard signs and other printed material. Your branding isn't just a logo. It is an identity to your business. It is something that you can now put everywhere and plaster everywhere, confidently knowing that it's going to help you attract the right types of customers because you finally look the part. When it comes to ROI, well, strong branding improves a lot of different things. Higher conversion rates or acceptance rates. You can, again, raise your prices if you're trying to be a more premium service provider. Well, now you look the part and can actually command those prices. And of course, you have to make sure the quality of work is there. But you can get better quality leads and jobs because you're attracting the right type of clientele. You can, of course, get more commercial work as a result if you're trying to get more commercial work, that is, by looking the part. And ultimately, too, Internally, from a team pride standpoint, you now feel like you're part of a professional operation and a professional business when your branding is in place and is up to par. You look like you belong to a well-run organization, and that means something. And it might not be perfect, or there might be some intrinsic value there, but at the end of the day, it's about cohesion internally and externally, about feeling like you're part of a team, part of a business that knows what it's doing and is trying to grow and has big goals ahead of it. So all that said, step 1 of 3, very quickly, what we're going to do here is just say, hey guys, if you are considering branding, here's some questions to ask yourself. Evaluate your current brand and think of these. Is your logo modern? Does your website reflect quality? Does your trucks and your uniforms look consistent? Do you have a clear message and identity out there in the marketplace? I mean, would customers trust you at the end of the day? And if you answer no to any of these, then you need to start considering branding as something worth investing into. Also think about what you're doing in 2026. Are you going to be adding crews or routes? Are you going to be targeting more commercial work? Are you thinking of raising prices? Are you going to be expanding your service line? Your branding should match the growth that you are creating for your business. So again, for example, if you are changing your business name from just lawn care to something to do with landscaping, your branding should reflect that. Your name, of course, should reflect that, but your branding, your logo, your colors, it should all reflect who you are becoming as a business and allowing you to attract that type of customer in the market. And step 3 is just building the budget, right? What I would say is prioritize branding early in the process. Prep your trucks, your uniforms, your website with your new logo and all the different branding patterns or standards that you might have if you're working with us. And then ensure your brand is fully consistent and cohesive before the season starts. At the end of the day, you want to make sure everything looks great, everything looks professional, and you get it out there ahead of the busy spring rush. And that doesn't really mean that you have to get things done in January. Winter, there's fall work, there's so much going on that there's no perfect time to do it, except do it before you start investing a ton of money into marketing and advertising, because you want to make sure that you're building on that consistency, you're building on the cohesion that your branding provides and putting out the right message and image into the minds of the customers that you're trying to attract. So that's what this whole presentation is hopefully about. Hopefully that's your main takeaway. Again, I invite you to visit us at brandable.com. We're always here to help answer questions. We do have straightforward prices and services and packages right on our website. So you can always check that out, see visuals, see what you get, sign up right on our website as well, or send us a message and we're happy to help. But guys, that's branding in a nutshell and what you should be considering in 2026 when you're going through the budgeting and planning process. And again, any questions, reach out to us. My name again is Adam Fullerton. Thank you very much and enjoy the rest of the presentation.
Awesome. Thank you so much, Adam. That's such a crucial aspect of business when it comes to the branding and marketing piece. And I think being able to protect the revenue and make sure that you're hitting those revenue targets is so important. And there are not many drawbacks to getting too many leads, because even if you put yourself in that category where you feel like you're getting too much leads, then you can dial down even more to then work with the most profitable customers and contracts. Whether you're a route-based company and you can really dial into the route density as much as possible, and it'll give you the confidence to shed some of the customers that are outside of that route, when it comes to that denseness, or even more the install work. Maybe right now, because of the leads that you're getting, you're 70% of the work that you do is great, right? It's those projects that you're utilizing your equipment well. You can operate really efficiently, but those other 30%, you're kind of just doing it just because maybe you want to make sure that you're recouping some overhead or whatever it is. Now, if you're able to dial down and get more leads, then maybe you can get more that really align more with those specific projects that you can operate very efficiently and profitably. I love to see companies spend 1, 2, 3 percentage points higher on marketing to then get an ROI on net profit, 5, 10% more, right? And those are things that we see. So definitely, I shared Adam's info in the chat as well. Definitely recommend reaching out. And such a big aspect. If you find yourself in 2025 that was something that was a limitation when it comes to, oh man, I shot for $1 million in sales, but I hit 800. Really consider these things, because, and that's in all aspects of your company. As we touched on yesterday, think about what happens if I don't change something, or what happens if a certain aspect of the company doesn't go as planned. What is, as you're doing that scenario planning, what are ways that you can prepare, make sure that you're able to hit that revenue goal. And that's, I think this is part of diversification in a way as well. So thanks again, Adam. Thank you for everything you do within the industry. And, another line item that also falls within overhead is insurance. Not the most exciting, potentially not even as exciting as things like marketing, but it is more exciting than accounting. So definitely give that to Greg. So Greg Garcia is our next speaker, and he's going to go through budgeting the insurance line items effectively. And again, Carl and I were discussing, especially some of those items, similar to how when Erica spoke a lot about yesterday, a lot about some of the overhead line items, the certain things that maybe you don't focus on during the year because your time is probably not even as much best spent looking into a lot of these things. But that's why it's good to leverage experts in those items. And Greg Garcia is one of them. Very well respected within the insurance side of things in the green industry. He's a partner with Rancho Mesa Insurance Services Incorporated, specifically in their landscape group, specializing in risk management for lawn and landscape companies. He helps contractors secure proper coverage, identify compliance gaps, and reduce long-term insurance costs. Known for his educational, straightforward communication style, Greg focuses on helping owners truly understand their policies so they can make informed decisions that protect their operations, equipment, people, and profitability. And when I look at the services that Greg provides, it's similar to, for those of you that are familiar with Cycle CPA and what we do here, I think, and even many of you have your niche as well. Maybe it's a specific kind of install project or, specific kind of properties that you like to maintain. I think finding people, like I said, that have that expertise, whether it's in marketing, insurance, and other aspects. But super excited to hand it over here to Greg to really dive into the insurance line items within the budget as we're thinking about 2026.
Hello, my name is Greg Garcia. I'm an insurance agent here at Rancho Mesa Insurance, and I focus on insuring landscape and tree care companies across the country. I put this slide on to start just to show our volume within the industry, as this is all we do, is focus on the green industry. Today, we're going to be talking about two major insurance line items. I know it's coming up for budgeting season for a lot of you landscapers out there, and I want to touch on two insurance line items in particular. One would be workers' compensation, and the other one would be commercial auto. So we'll first start with workers' compensation because for a lot of landscape companies, it's the biggest expense in terms of annual insurance cost. When I think about work comp, the first thing that comes to my mind is experience mod and controlling your experience mod, because really ultimately that's the best way to control your work comp insurance premiums. What I mean by that is that every landscape company out there is given an experience mod rating. Some might be 1.75, some might be 0.65. It varies based on how well that individual company is managing and preventing workplace injuries. So the goal for all of our landscape companies is try to keep your experience mod below that 1.00 X mod factor. And the best in class landscape companies are doing this a few different ways that I'm seeing. First, they're making sure that their employees are properly trained, right? So when they're, going to use a string trimmer or a pole saw or drive a skid steer, whatever it might be, making sure that employee has proper training before they go out there and do that work for that day. The next thing that I see landscape companies do is they're making sure that their employees are wearing the proper PPE. So that could be wearing protective glasses, gloves, helmets, whatever it might be, to making sure they're going to try to help prevent any workplace injuries. Another step that landscape companies are doing, daily job hazard analysis, where they're going out before the job has even been started, and they're looking for potential hazards for their employees, and they're jotting them down, making sure everybody's aware of those potential hazards. So that's super important. Another way that some landscapers are trying to be proactive in preventing claims is implementing a stretch and flex program. So that would be, meeting at the yard, and before the companies go out to their job sites, they're engaging in a quick 5 to 7 minute stretch and flex, and making sure that their bodies are loose. By doing this, by just focusing on the landscape industry, we know that the number one work comp injury are strains. So this is a great way to be proactive in trying to help mitigate some of those claims. So by doing all these steps, you can be proactive in trying to mitigate workplace injuries from happening, but inevitably there's going to be one, right? There will be a work comp injury for whatever reason. It could be an accident, something happened, somebody wasn't trained properly, somebody's going to get hurt. So what do you do now? The next step into controlling that claim is making sure that you have a strong return to work program. And what I mean by that is when an employee gets hurt, they go to the clinic, that doctor is going to put some workplace restrictions for that employee. Being able to offer that employee modified duty to be able to come back and maybe do something that not in the field, but maybe, do some paperwork or whatever it might be, your modified duties that you're able to offer for them to keep them earning their same wages. And this is critical because what it does is it keeps temporary disability off of that claim. And in turn, that's absolutely going to lower that claim cost. And then also, we just found out that lowering claim cost means lowering experience mod. Controlling your experience mod means lowering your annual work comp premiums. I want to switch gears really quickly to talk about kind of what underwriters look at when they're looking at your specific account to see how much they need to charge in insurance costs for your workers' compensation policy. So underwriters are looking at a few major categories. One would be your current and 5-year loss ratio numbers. So loss ratio is, think of annualized premium divided by claim costs paid out in that particular year. So let's say that your annual premium was $100,000, and in that policy term, you guys the carrier paid out $35,000 in claim costs. That would be a 35% loss ratio for that particular year. So for an insurance underwriter, that's good. They want to see that number at 35% or below. That means they're profitable on that account, and in turn, they're more likely to add more scheduled credits and get more aggressive in terms of pricing to try to earn your business or try to retain your business. So that's super critical to continue to monitor your guys' loss ratio for the current year and the last 5 years as well. And then going off of that, there's 3 other categories that an underwriter is really going to look at. They're going to look at your average claim cost, your frequency rate, and your indemnity rate. So how much on average are you paying out for a claim, for one claim? How often you're having claims, right? Your frequency rate. And then the indemnity rate would be lost time. Within those claims, how often are they resulting in missed time, which in turn is temporary disability being paid out on that claim. So those are some really critical parts of where an underwriter is going to be looking at to underwrite your account. And I just want to pull this up really quickly. For our clients, we have what's called this KPI dashboard, and it really highlights a lot of the things we just talked about. So I'm going to share my screen one more time here. So here it is, and you can see it has a lot of the things that we talked about. Here's kind of like what a mod, this is just a sample one, but here's like your estimated mod. We're always estimating the next year's mod for our clients. We talked about the loss ratios. Here's the 5-year and the current year. And then down here, we have the average claim cost, the frequency, and the indemnity rate. And what's nice here is we actually stack you up to other landscapers within the green industry. So I absolutely use this in my submissions constantly to try to get the best pricing that I can get for my clients. But just wanted to kind of shed some light on that as well. So at the end of the day, with work comp, managing and controlling your experience mod is a great foundation to try to help to reduce workers' compensation insurance costs. So managing that experience model, keeping it below 1 or at 1 is a great way to try to reduce annual premiums for insurance. Next, we're going to talk about another major concern for landscape companies across the country, and that would be commercial auto. Commercial auto has probably been the hardest market across the country for going on 2 or 3 years now. And what I mean by that is we're seeing annual increases on that line of insurance year after year. And really typically that's just due to these insurance carriers that are not being profitable on that line of business anymore. So we've talked about on work comp looking at that 35% loss ratio. Insurance carriers need and want to be profitable in order to continue to, offer sustainable rates for their policyholders. What we're seeing on the commercial auto side of things is that insurance carriers are basically they're underwater. They're losing money on this line of business, and in turn, to try to make up that ground, they're increasing their rates year after year. And this is typically due to, we're seeing a lot more litigation now within the commercial auto space. Medical costs have gone up. We've seen nuclear verdicts, happen more and more, which would be $1 million settlements. And underwriters and carriers are really being more scrutinized when they go into underwriting account. Even here, I'm out here in California, we've seen over the last couple of years, probably 3 or 4 insurance carriers just non-renew their entire landscape book of business. And this is unfortunate because this really saturates the market and doesn't allow for that market competition, right? If there's less carriers offering terms on commercial auto, we know rates are going to continue to increase, and there's not as much, market competition to try to lower some of those rates. So that's been a huge issue as well. So what can landscape companies do to try to offset some of these increases that we're seeing year after year? Well, what I'm seeing with the best-in-class landscape companies, I'll give you a couple examples, is that they're conducting annual driver trainings. And really, I think we should kind of stop there. And I think that's where a good fleet management system starts with who's getting behind the wheel of your commercial vehicles. I think it's super critical to continue to, manage your MVRs, looking at those motor vehicle reports, making sure that employee is eligible to be a driver for your company, and really setting the standard high of what it means to be a driver for your company is absolutely critical. The other thing that I think needs to be done is continuing, or what I'm seeing best-in-class landscapers do, is they're staying on top of their vehicle maintenance. They're making sure that the brakes are checked, the tire pressure is good, the oil is good, all of that stuff is rolling nicely to try to keep those vehicles, performing at their best level. When I've gone to a few industry events where you get to go to field trips and you get to see an actual landscaping operation, and the most impressive ones that I've seen is that the ones that have company rollouts, where before their vehicles even leave the yard to go to the job site, they have an employee with a clipboard, and the truck is kind of driving up slow, and as they're driving up, they're doing blinker, windshield wiper, checking the brakes. Basically one last check that this truck is ready, ready for today's work and is going to be as safe as possible out there. So a company rollout is also a great way to try to create a stronger fleet safety and try to, again, mitigate and be proactive in managing these claims. The last thing, like I said, we go to a lot of industry events, and the last thing that we're seeing a lot of landscape companies do is kind of switch their focus to improving on the technology side. So whether that would be GPS or dual-facing dash cams, I think those are ultra critical and kind of the next step for a lot of landscape companies. Yeah, we're doing all the baseline stuff and things are good, but how can we improve even more? And with the advancements in technology, I think that's the next step is to go and get those dual-facing dash cams and getting the GPS kind of put into the vehicles. What we're seeing with those dash cams and the GPS is it's basically reinforcing to your team that we take driver safety very, very seriously here. If you have a camera on that driver, they're going to be less likely to be texting while they're driving. They're going to always be wearing their seatbelt. The GPS is able to track speeding, harsh braking. So you can use all of this data in your favor to train drivers to, making sure there's corrective actions if there's been some notifications that this driver has had some incidents, whether that be speeding, harsh braking, harsh turning, using their cell phone while driving, whatever it might be. But on the flip side, it can also help in rewarding that good driving behavior, right? If you see someone evade a crash or has been focused or has not had any infractions over the last 2 months, there can be some sort of an award. So it can be kind of used either way there. The last thing that we've talked about with the dual facing dash cams would be basically exonerating you guys in a potential auto accident where there's some finger pointing going on, right? So you get into an auto accident where the third party is clearly at fault and they're pointing the finger at you and you're saying, yeah, absolutely, it's not our fault. Well, if you have that dual facing dash cam, you can show that clearly, and usually those claims get settled rather quickly. And all this is doing is just trying to, again, prevent and being proactive in fleet management and not having these auto accident claims. And if you are one of those companies that feels like, I haven't had an auto accident in 10 years, my loss history is super clean, why do I continue to get these 10 to 12% increases, 10, 20, 30% increases on my commercial auto every year? Well, there's a few things that you guys can do. Is you can ask your insurance professional if that carrier can increase deductible limits. So maybe increasing your comp and collision deductible limits from, let's say, 500 to 1,000 to maybe 1,000 to 5,000, whatever you're comfortable with as a business. The other thing you could see is if that particular carrier offers auto liability deductible option. And again, this is just another way to basically put a little bit more skin in the game, but you're doing that because you're saying, hey, I'm not having these claims, so I'm fine with putting kind of my skin in the game, knowing that we have a good fleet system, we're safe here, and I feel comfortable about doing that. So by doing all of that, it also looks really good in my submissions as well. So for our clients that have the GPS, that they're doing the rollouts, that have safe driving trainings, annually, all of that stuff I use when I send the submission into the underwriter and saying, hey, I know the auto market's a challenge, but this landscape company they shouldn't be lumped in with everybody else. They're doing they're going above and beyond what's asked of people to try to mitigate and be proactive in their claims handling. So, in closing, I just, we talked about a lot of things here, and I know that was probably a lot, but I want to say I appreciate your time, and just kind of to wrap it all up. So to try to, decrease annual insurance costs, it starts with controlling the experience mod first and foremost, having great safety procedures, whether that be on the work comp side of things or on the auto, and making sure you have a strong safety culture. And by doing these things, you should see, either stability within your insurance costs, no spikes going up or down, just kind of stable year after year, what you're going to expect, and then ultimately, hopefully seeing some decreases as well. So thank you all again for your time. If there's ever anything I can do for any of you, please reach out, and I hope you guys have a great holiday season.
Just want to thank Greg for joining us, and ask your accountant, and it might be Cycle CPA, right? We can help you with this as well. Look at the insurance cost as a percent of revenue for the past 3 years and see how that's trending. That way you can really keep tabs on that and leverage people like Greg. This guy knows the industry and insurance really well. So there's, you don't have to be an expert in stuff like this. That's why there's people like, Greg and Retro Mesa Insurance. So definitely check out his info in the link that we shared in the chat there. And, but that's phenomenal stuff. Thank you very much, Greg. And, our next speakers, this is, really appreciate them taking the time. They're coming from an industry powerhouse, Ewing Outdoor Supply, and it's Lisa Firestone and Steve Sakurai, and they're both national managers at Ewing Outdoor Supply, and Ewing is one of the largest green industry suppliers in the country with over 250 locations. And together, Lisa and Steve bring decades of experience supporting contractors with irrigation, lighting, water management, and overall operational efficiency. Lisa and Steve work closely with landscapers across the country, offering product expertise, training, and business strategies that help companies improve margins, streamline workflows, and scale with more confidence. So they're going to cover outdoor battery-powered equipment and what that transition looks like. And I know many of you, this is top of mind. And there's been a lot of different news within this area of the industry. So really appreciate Lisa and Steve taking the time here, and we'll let them take it from here.
Everyone, thank you for joining us and taking the time to sit with us through our outdoor battery-powered equipment presentation. My name is Steve Sakurai. I am the golf and landscape supply category manager, and I have here with me Lisa Firestone.
Hi, everyone. Yeah, thanks for joining us. We're just going to talk a little bit about how to make that transition to battery-powered equipment a little more smooth and give you some tips that we've learned along the way in helping contractors make that transition. So our role as a supplier, it's really to help solve issues and that are pain points for our contractors. And one of those is switching to battery, whether it's because a landscape contractor wants the benefits of battery, or whether they're being told they need to because of state or local regulations. We're going to talk about that and how you can turn that into a positive. The transition to battery powered tools, it can be a cost savings.
Wait, did you say a lower cost to transition?
Well, and I get it. I know that the sticker shock can really turn people off initially. But if you really look at how that plays out over the long haul and spread the cost of those batteries out over many months, then you can actually find that it will save you dollars. You're basically paying for your fuel up front. Typically, that break-even point is about 18 to 24 months. And from then on, you're just paying the cost of charging, which is very small in comparison to fuel. You have reduced maintenance, zero emissions at the point of use, noise reduction, which allows you to start earlier in some cases and work later. So there's some different working advantages. There's some advancements in battery technology that we're going to talk about. So our goal of the presentation is to provide practical insights to help contractors transition smoothly to battery-powered equipment.
I've always heard gas is better than battery. And I'm guessing that may have been true at the beginning, but I'm sure things have changed as technology always does. So tell us a little bit about the changes that have been made.
Yeah, I think that was a fair statement, 5 or more years ago. But if you think about the innovation and that technology that's come on board in this last 5 years, I mean, Tesla is a perfect example. Their claims for 0 to 60 are just fantastic. And that's true in the battery powered outdoor equipment category as well. That torque and that power is almost instantaneous. So it's come a really long way. And there's not the concern with power and torque that used to be there. Improved runtime has also come a long way. It's still something that contractors need to plan for in terms of having enough batteries, but it's doable, and it just takes a little bit of extra planning. And it can really minimize the need to go get more gas or take the time to, mess with pouring gas, et cetera. So run times have improved. And one of the things that we recommend is test before scaling. So you don't need to go in too big. You want to test and make sure you understand what your needs are before you make those bigger investments.
Those all make sense. So if I want to make that transition, how do I make that transition? What are some good tips to keep in mind in doing that?
Yeah, so one of the things that we've learned as we've gotten into selling battery powered equipment is that if you're a landscape contractor that wants to make that switch, you need to do some evaluation of your crew. So how many hours are they trimming? How many hours are they mowing a week? How many hours, are they using a string trimmer or brush cutting or whatever it is? Understanding, it doesn't have to be exact, but understanding what are the average hours per week that the crew is doing the different tasks. And then another key important part of making the transition is demoing different equipment and different brands of equipment. Different manufacturers have different strengths, and so understanding what those different options are for you and your crews is really important. And one manufacturer might be better for someone that does a lot of mowing versus a different manufacturer for someone that does a lot of tree trimming and so forth. So again, demoing and looking at the different options and involving your crews in that and getting their feedback. The third thing and really important is charging strategy. Again, we talked about gas is kind of easy. You can run down to the gas station and just fill up your tank. You do need to plan a little bit. So you need to look at how many batteries is the crew going to need in a day, and how are we going to charge those? Are you going to charge them all overnight? Are you going to do some in-field charging? There's lots of different options that have come on the market over the last couple of years. One of the brands that we sell, which is Ego, has a PGX system, which can charge several batteries overnight, up to 22 of their largest batteries, in fact, on one 15-amp circuit. So that avoids the need for, lots of extra infrastructure. However, if you have several crews, let's say you have 15, 20 crews, then you are going to need to look at infrastructure evaluations and what may need to happen to support all those crews over time. And again, developing a plan, I wouldn't do it all at once. Developing a plan of how you're going to make that transition over time is smart to do.
Sounds like planning and demoing are some, key things to keep in mind, especially planning on what your day looks like. What about the financial considerations for moving to battery?
Yeah, and we touched on this early on in the presentation. Again, I get it, that sticker shock can be overwhelming. There is an upfront investment, especially that initial cost of the battery. But there's lots of ways to plan for that. So there's financing through the distributor or manufacturer. There's doing rent to own programs that spread those costs over a much longer time. And then you're really looking at again, that if you're thinking of paying for your fuel up front with batteries, you're now spreading it across to be normal. You got to think about what you're spending on fuel today and what you're spending on maintenance costs. When you add that into your overall cost, you're going to see that the investment isn't as big. I think I covered everything, considering, again, just there's different ways, and Cycle CPA can help you figure out the best way for you to make that transition as a contractor, and what way works best.
So those are all good tips and for making that transition over to battery. Is there anything else that you can think of that would help in considering making that change?
Yeah, just a couple last things before we sign off. I think some additional advantages are the connectivity features in battery powered equipment. So many of the manufacturers have IoT capabilities or Internet of Things, and they have fleet apps which can track the usage, the location, the performance of the equipment. So it's really helpful in managing the fleet, looking for optimization in terms of, do you really need 3 people or 4 people on that crew? Maybe you can scale it down by one person, or there's lots of, scheduled maintenance for equipment. You now know when equipment needs to have some scheduled maintenance. So that connectivity can really play a big role in effectively managing your equipment fleet. As a distributor, whoever you're buying equipment from, they can be there to offer guidance and assistance and product demonstrations and financing to help you make that transition. And then lastly, just kind of in summary, start small, plan, demo, so you know what you're getting into, and leverage your partnerships to make sure you're successfully adopting the right brand of battery power equipment for your crews.
Great. Thanks, Lisa. Thanks for all your tips and for all your insight. Was very helpful. And as always, reach out to your local distributor, and we're there to help.
Thanks, Steve. It's been a pleasure.
Fantastic stuff. That was great. So really interested to see. Is there anyone that currently works with Ewing at all here? And also drop their website in the chat as well. But really want to thank both Lisa and Steve taking time to share a lot of this stuff, and it's interesting now that we're kind of getting as Lisa mentioned, we're kind of getting to that point where a lot of this battery powered equipment is starting to be utilized more and more. So definitely look into this, and whether it's asking questions in the chat right here or reaching out to them, but really want to thank them, and I do want to just give a shout out to them just overall. I mean, when we reached out to them and we told them, listen, a lot of the people in our community are looking for different ways to, budget for their equipment next year, and some of the considerations and things that are up and coming in the market. And there was no hesitation there. So I really want to thank them. And, it's all phenomenal stuff.
Fantastic. Thank you.
Absolutely. And our next speaker is Mike Callahan. So Mike is not only an awesome guy, but he's going to be covering buying back time with software. Software is a very interesting topic, and something that I think companies are really able to gain great efficiencies and really able to do some pretty great things when it comes to just finding those different softwares, and not just the softwares like the field management softwares, but also different aspects of your company. Like many aspects of the administrative side of your company it can be optimized when it comes to software. And so we spoke with Mike and we said, listen, Mike, software expense, the software line item, can we really dive in there and go from there? So super excited to have Mike Callahan join us. Mike Callahan is the owner and president of Simple Growth, and an automation and consulting company serving lawn care and landscaping businesses. As the creator of Lawn Care OS, Mike helps contractors systematize workflows, automate sales and scheduling, and build companies that grow without relying solely on the owner. So super excited to have Mike here, and I'll let him take it from here.
Hey, Mike Callahan here with Simple Growth. Wanted to take a few minutes to dive into one of my favorite line items on the profit and loss, which is office supplies and software, and how lawn care companies or any service company can go in and streamline their operations and scale profitability through using this area efficiently inside their software. I want to take a look at the measurable financial impact, cash flow ROI, and going in and addressing some of the common mistakes when scaling a business, how software can not only buy time back, but create accountability and clarity around what needs to be measured and acted upon in your business. So without any further delay, I'm going to hop in here and kind of go over some high level areas and actually dive into a software here that will show you some of the high level things that can be done and accomplished. So the main problem we're looking at is you didn't really start your business to be buried in chaos. There's manual tasks, scheduling, estimating invoices. Traditionally in the beginning, there's disorganized communication and scattered spreadsheets. So through the use of a software or a CRM, we can start to organize this in a scalable manner where the business owner can now start to delegate and manage the business and not have to be the bottleneck and the chief problem solver. In addition to that, we're diving in looking at a crew inefficiency or hopefully some efficiencies and driving accountability. So each crew member knows what they do on each day, whether it's weed whacking, pulling weeds, or anything else in the field, how that contributes to the overall mission of the business. And at the end of the day, when the business owner is managing multiple spreadsheets, doing this throughout different manual processes, there's really no time for strategy, growth, or even their family. So the opportunity is software is going to be your silent operations manager. We're going to operate repetitive admin work through automations and different software platforms. I'm going to dive in and show you a live process of how we actually tackle this. We're going to centralize communication and scheduling, track jobs, budget versus actual and performance in real time, and build repeatable systems that can run without you, the business owner. Once again, we're shifting that onto your team and off your shoulders. Core systems we want to go in and automate is our estimating and CRM, consistent quotes with automated follow-up. Let's not forget about welcome and acclimation, getting that credit card on file, upsells, overdue invoices, and a whole lot more that can be tackled there. Scheduling and routing, so reoccurring schedules, optimize routing to minimize the drive time of that non-billable that's going to show up. Time tracking, we want to be able to use a CRM such as Service Autopilot or Copilot CRM where the crews are clocking in and out. We can roll that up into a dashboard so we get real-time data, how the business is performing, each crew is performing. What I'm going to probably suggest or tell you what I've seen over well over 20 years of doing this is there's some crews that are absolutely carrying the company on their back, and there's others that are bleeding it dry through a automated and use of a software system. Will be able to clearly see each crew for what it is and what it produces. Billing and payments, we want to auto create invoices and hopefully sync with QuickBooks Online and be able to run either ACH or credit card processing in minutes, not hours. And finally, our marketing and nurture, automated text, emails, and going out when folks are happy to get those social reviews on Google, Yelp, and the others. But really what we're looking at here is real results, saving 2 to 3 hours per day at a bare minimum, automated estimates with no late night quoting, potentially automated quoting right on your website, live 24/7 with something like Simple Estimate through spatial awareness and AI. Crew GPS, less drive time, more billable hours. Auto billing, zero paid invoices or zero paid unpaid invoices, and dashboards for instant clarity on margins. So the tools that power it, some of the ones that we use here at Simple Growth and my companies is Service Autopilot, Jobber, Copilot CRM, and the Lawn Care Operating System. As far as automations, a lot of folks have automations built into their CRM, such as Service Autopilot or Copilot CRM. If not, the other product that we utilize here at Simple Growth is Go High Level, where we tie that in through a Zapier connection, where we'll tie that into an Aspire or, say, a Jobber. And finally, QuickBooks Online for seamless accounting. Joe and Carla have got it nailed over there at Cycle CPA. So if you're not using them, definitely look them up for their bookkeeping and financial services. Probably about 70% of our clients in our coaching division use them, and just phenomenal results. But as you're looking at it really visually, it's going from lead, estimate follow-up. We're going to schedule, we're going to complete the job, we're going to invoice it, and we're going to have job costing that dials into that piece. So the implementation blueprint that I'm going to recommend is document your current workflow, identify the biggest time drains, choose the software that integrates end-to-end or the software that has everything internally so there is no integrations. Automate one process at a time and train your team and measure the time saved. So an operating system for success. I'm going to implore you to take a look at this process. I'm going to show you here in a minute how to take back control of your time. Start automating one process this week. Estimating, scheduling invoices. When your software runs the systems, your business finally runs itself. So what I'm going to do is jump into a software that we've created here called the Lawn Care Operating System. Right in here is a budget, but if you're going in and utilizing the software or any software, the biggest thing on my P&L is direct labor here. So what we're doing is diving into, let's just say, our lawn care division, and we add in employees. So we're going to go in and put in a technician on crew 1. Their position's a technician, and say they're making $23 an hour, and we're going to put them for 1,080 hours. We're going to put them in. We've created our whole entire division with budgeted hours and wages. The next part is we'd want to go in and create our labor burden. So we'd put in their wage, hours worked, hours per day, our FICA, state and federal unemployment, workman's comp, and any medical or paid time off with other benefits. That's going to get us a loaded wage with a labor burden percentage. And I would suggest that we do that for each division in here. And now we have per division a total of how many employees we need to hire this year, the average wage with OT, annual hours, and our total annual wages with labor and labor burden. Next area that we'd want to look at in our P&L for direct labor is our non-production staff, so maybe our CSR and CEO. Same idea, we're putting hourly rates, how many hours they're working, and the total wage and burden, broken down with separate burden based on the different workman's comp codes for that office. Finally, we'd go into our equipment. We'd want to go in and grab a pre-templated say vehicle such as a truck, and this is our commercial mow truck. We bought it now for $65,000. We financed it for 5 years, interest rate, years of use. We're looking to sell that for about $25,000 when we're done. We're using it 180 days a year and 8 hours a day. Inflation's gonna be around 3% as we're making this video. We're gonna look at our insurance, licensing, and fleet washing, miles per year, miles per gallon, cost of fuel, oil change interval, cost of each oil change, any air filters and their cost, and finally tire maintenance. This vehicle right now is costing us $11.40, and we now have a yearly and a monthly operating budget for our P&L. So once you go in and save that in there, we have created our equipment fleet, and we're going to go in, and this production fleet is just producing out in the field. We've summarized the vehicles and the equipment. We've created our overhead estimating or quality control vehicles. And then finally, we are going in and building out that P&L. So that office supplies / equipment would be living right here. You'd be able to add that in. So let's just put this as CRM. And let's say that's costing you $15,000 this year. We'd add the category. Main idea there is we're going to set our income for each division. Our direct labor and labor burden would pull through. We'd have materials, equipment, and subs. As you take your direct costs and subtract that from your income is your gross profit. There's some interesting benchmarks you may want to be looking at as a percentage. And then we have our fixed operating costs here as we drive down, and now a percentage of sales. So if you believe in a MORE system, a multiple overhead recovery system, we're doing a markup of 10, 25, 5% of your material, equipment, and subs. And this is going to give us a labor overhead recovery multiplier here of 1.79. So finally, you can go in, update that, hit our billable rates. We're going to create a new configuration. If we had a 2-person crew working 8 hours, and they are in my enhancement division, and our profit markup is 20%, or let's just say 15%. There's our labor with profit built in, our hourly rate with truck and trailer here, and we're using that 8 hours a day and a 15% margin. $104 for our truck and trailer, our equipment with a 60 and Z. Right there, we're going to be using that probably 4 hours a day with a 20% margin. $47.52, and our small equipment is our handheld stick badger weed whacker blower. We're going to use that also for about 4 hours and a 15% margin there. So all in this type of crew now through the software that's automating everything on that P&L, we know non-emotionally for that division crew we need to charge $76.57 because our break even before we make a profit is $66.47. And that's going to drive into your scheduling billing software where we can delegate our scheduling at $12.25 a day because it's costing us $10.63. Final part I want to leave you with is driving this all back to a company scorecard. So we're going to set targets for each area here under company health and growth metrics, and we're going to track them each week, budget versus actual, with a status of on track, at risk, or off track, and who actually owns the metric. This is the part where software becomes absolutely powerful because now we're setting goals, everybody knows what's expected, and we're holding them publicly accountable. So I'm looking at profit and loss, cash on hand, revenue per man hour per division. Growth metrics are going to be our total clients, new clients canceled. Are we growing or contracting? Marketing, ad spend, clients generated, and our client acquisition costs, what it costs us to get that client. Office, operations, budget versus actual, and accounting and financing. So we use this at Simple Growth and all our businesses, where everybody on the leadership team fills out the area they own, and now the software or CRM on your budgeting line item holds them accountable, and if they are not hitting the goal they set in the notes area, they're coming with a 1-3-1 process. One problem, why we're not hitting the issue, we're not hitting the target, they're going to come up with 3 solutions and one reason or one solution they believe is going to work. And by doing such, the power of software on your profit and loss now has delegated, created accountability, and most importantly, bought the time back for the owner. And now anything that's not hitting a target goal is not the problem on your shoulder, but the person who owns it being publicly accountable and tracked.
Awesome. That's some great stuff, and super excited to move on to our next speaker. Not sure how much everybody heard before I got disconnected there, but we're going to be introducing here Tito Caceres as our next speaker. He's going to be covering maximizing your budget for effective recruiting and onboarding. So really want to thank Tito for joining us, and let him take it from here.
Hey everyone, Tito Caceres here, Managing Director at Bloom Talent Solutions. I'm excited to partner with Cycle CPA for this event because what we're talking about today hits pretty much every landscape company, whether you're doing your first million or your past 10. And I'd like to be covering 2 areas of your budget that most companies underestimate or don't plan for correctly. First one is professional fees, specifically recruiting. What does that typically look like? And then overhead and admin salaries, specifically internal recruiting and onboarding. These are 2 line items that can either become your biggest bottlenecks or the reason that you finally scale with confidence. So in this industry, the one thing every owner learns, no matter what size you are, is this: your business grows only as fast as you hire the right people. And so if you're a smaller company, under $5 million, one bad hire can set you back an entire season. And if you're a mid-sized company doing between 5 to 10 million plus, more or less, inconsistent hiring is usually the reason you stay stuck at the same revenue more or less year over year. And so people problems look very different at different sizes, but the impact is always the same. You lose margins, you burn out the teams, you churn clients, delayed growth, and then many a times the owner's stuck doing everything. And so today I wanted to give you a simple framework for budgeting in 2026 so you stop reacting to hiring problems and hopefully start preventing them. So where we can start is with professional fees, specifically tied to agency recruiting. So external agencies, more or less, that you can utilize and leverage to support your growth or hopefully maybe fill a critical role. Most landscape companies fall into one of 2 categories. One, small companies, which typically rely on job boards, referrals, or basically whoever's available because it feels cheaper. And then mid-sized companies, they assume that their internal team can handle pretty much everything, and even leadership roles that require serious experience. But both groups end up losing far more money than they realize in the realm of talent acquisition. And so here's kind of the hidden financial drain of poor recruiting. And this one is what, in terms of what a mishire can really cost you, which is, anywhere between $10,000 up to $30,000 in direct wages and onboarding, $20,000 to $60,000 in production loss or rework, $5,000 to $20,000 in overtime because the crews are understaffed, and $50,000 to $200,000 in lost contracts or unhappy clients. And so suddenly that quick hire or cheap recruiting solution becomes a six-figure mistake. And this is where landscape owners feel this pain every season. They just rarely calculate it, right? And so, we're a recruiting agency, and we support companies all around the country, mainly for mid-level management to executive level positions. And, many times people wonder, when does it make sense to use a recruiting partner? We're one of many in this industry. And I say that proudly because I feel like it's still something that is underserved in this industry. And we have a lot of questions behind this. And here's a simple decision tree. So you can use an agency when you need to hire typically account managers, mid-level management positions, account managers, business developers, project managers, branch leaders, operations managers, division heads, or basically the rule of thumb is ideally any role where one mistake can hurt your margins. And these are not roles you recruit casually either, right? They're just not, and they shouldn't be taken lightly that way. So in terms of budgeting rule for 2026, if you know that you'll need 2 to 3 hires next year, like key critical hires, you should ideally look to budget for it right now. Typically, that means in terms of recruiting agencies and what they typically charge, that could mean anywhere between 15 to 25% of a salary per hire. But why? Well, because the ROI is real. A recruiting partner, ideally that's specific to the industry, can fill your roles much quicker. Usually they can leverage databases, and this is what they do day in and day out. Higher quality of candidates, lower turnover, ideally from a great placement, from a great person that they're looking to fill this position with, comes more stable operations, more revenue per manager, and best of all, hopefully better client retention. Because a good hire makes you money for years, a bad one costs you for years. Now let's talk about overhead and admin salaries, specifically internal and onboarding, internal recruiting and onboarding. This is very different than using an external recruiter. And some companies, many companies utilize internal recruiting for their talent acquisition needs. And so this is an area that almost every landscape company, big or small, typically miscalculates. And here's what typically happens. You got an office manager, branch administrator that posts a job. Then HR screens the resumes. An operations manager, a branch manager, then goes and screens, interviews them between fire drills. They're trying to, take time to have, a very clunky interview with someone. And then the owner jumps in when everything is falling apart, and new hires show up with no structure or training, onboarding. And I've seen many a times even no office, no laptop, no paperwork ready. And so this isn't a system. Oftentimes it's just survival, right? We lose a client or we gain a client. We need to fill the role yesterday. We lost someone. Let's fill the role immediately. And so survival mode, unfortunately, can be and is extremely expensive, especially for the smaller and mid-sized companies. And so let's talk about onboarding, because again, this is kind of the survival mode, if you will, many companies kind of, do in terms for hiring internally. And so let's go on to onboarding, because what can a poor onboarding process cost you? So if your first 90 days aren't structured, production teams typically will take longer to ramp up. Account managers very likely will lose accounts. Project managers will probably overrun their budgets. Equipment may likely get damaged. Your culture will likely get diluted, and you will likely have turnover. And so, in turnover alone, it can cost anywhere between $5,000 to $15,000 per field employee. and between $20,000 to $50,000 per leader. And here's the good news. Smaller companies can start simple. If you're doing $1 to $5 million, you could budget for maybe a part-time recruiting coordinator, right? Someone that is just scheduling interviews. Especially if you're between $1 to $5 million, there's a lot of fires that you're putting out. You're dealing with a ton of different things. Everyone is wearing a lot of hats, and so maybe someone that could just be hired, like an admin support of some sort, who can just be a part-time coordinator, coordinating all the interviews with the internal staff plus the candidates to make a very streamlined recruiting experience internally. Clear job descriptions, very simple, but unfortunately a missed opportunity. And the great thing is now with AI, ChatGPT, I mean, it's so easy to optimize job descriptions more than ever. A basic onboarding checklist, just a very simple checklist to just make sure that everyone that's hired will have what they need, and understand what they're going to do in their first couple of weeks. Weekly check-ins for the first 30 days, very easy to do. And lastly, a 90-day ramp-up plan for new hires. So just to give the new hire an understanding of what their first 90 days will look like, so that they feel supported. And typically that will lead for them to stick around longer. That level of clarity is a game changer. For mid-sized companies, maybe building infrastructure. If you're $5 to $10 million, maybe budget for a dedicated recruiter or HR recruiting hybrid, a structured onboarding process, budget for tech, an applicant tracking system, and communication tools to make your hiring process much more streamlined. Hopefully, or ideally, manager training on interviewing expectations. So as opposed to just thinking or assuming that your leaders and your hiring managers are very good at interviewing, that could be something that could be a training on that. Best practices potentially on interviewing, legal and illegal questions to ask, and very, very important, clear KPIs for the new hires, that those are spelled out up front, so that the new hires know exactly what to expect when they're coming in. And this typically costs $60,000 to $120,000 annually, but it can absolutely stabilize the entire company. And when you think of the flip side of it, how much would you lose by not having some simple things or simple investments like this that could yield massive ROI? And in terms of the strong ROI, or the ROI of a strong onboarding, when it's done well, your productivity is cut in half in terms of time to productivity. Managers spend less time putting out fires. Teams stay longer, clients feel the difference, and margins improve consistently. And so for many companies, strong onboarding adds 2 to 4 margin points just by that. And so to wrap this up, here's the clearest way to build your 2026 budget for recruiting and people. Number one, 2026, your budget should include professional recruiting fees. If you're a $5 to $10 million landscape company or green industry, within the green industry or anything above that, and if you're planning to hire 2 to 3 strategic hires, you should budget 15 to 25% of each salary. Treat it like a growth investment, not an expense. Number two, internal recruiting and onboarding costs. Budget for systems, not firefighting. Small companies, keep it simple, but structured. And in mid-sized companies, dedicate real resources. And number three, a 90-day onboarding plan for every role. This alone will save you tens of thousands and stabilize your team faster than anything else. And when these two line items are planned intentionally, something amazing can happen, which is your business all of a sudden becomes predictable, your growth becomes repeatable, and you stop burning your people out, and you finally get to run the company at the level that you want. And so whether you're $1 million company building your first team, or you're at $10 million trying to break through your next ceiling, Your people strategy is the lever that will get you there. Budgeting for it intentionally is how you will turn chaos into confidence. So thanks again, Joe, and the Cycle CPA team for having me. Hope this brings some clarity as you build a stronger, more profitable 2026. And I'm always happy to help if you need guidance on talent strategy and or talent acquisition. Thanks so much.
Just want to say thank you to Tito. I think recruiting and onboarding is such a key aspect when it comes to building that plan for next year. He's, like I said before, finding those experts that you can leverage. And, so I included his contact information or his website in the chat. So definitely I recommend reaching out to him. Awesome stuff. Really, really want to thank you, Tito, for joining us here. Next, Carla and I are going to be taking a deep dive into overhead salaries, ROI versus the low cost approach in regard to certain overhead items and more in regard to that as well. So we'll get started with that. So as you're looking at the overhead for your budget, some should be evaluated more from the perspective of what value can be created based on that line item. Or can we get an ROI based on this? Instead of looking at it more from the perspective of, let's just try to find the lowest cost option for that given line item. And different examples when it comes to, what are some of those line items where you should look at it more from an ROI perspective? Things like marketing, software, professional services, employee training, leadership and development, recruiting. Also things that impact client experience. That's worth a lot more, right? Looking at things like how you're paying your sales team, or even as Ryan covered earlier in regard to the bonus plan. These are all things, and again, like just as an example, those things that could be done for clients, right? And enhancing that relationship with them. What is the impact that has on total enterprise value and just your ability to continue to service them and can continue to run a thriving company, right? So looking at that ROI perspective, because it might not, you taking time or one of your account managers taking time to do something that might cost a little bit more, it could pay off a lot better in regard to not only that account manager feeling like you care about your customers and the company, but also that client really feels it as well. So, sometimes you really have to look at things more from, okay, what value and what is that ROI that can be produced based off of that. Whereas some of the items where it's more of, okay, let's just control the cost, things like office supplies, utilities, aspects of insurance, facility expense, fuel, uniforms, right? So where, again, Erica covered a lot of these yesterday in regard to, okay, how can we negotiate with some of these vendors? And, how can we look into some of these expenses, making sure that we're reviewing it month after month, making sure that, nothing is increasing too much, especially as a percent of revenue. So again, I think it's important to really kind of separate, when you're looking at the financials, what are some of those items that you can look at more from an ROI versus more of just, okay, let's cut that expense. And a big aspect, I think of something that companies don't look into as much is looking at overhead labor, right? So think of that as anyone in your company that's not actually physically touching the work on the projects. So even if it's management and they're going to the properties, or maybe it's your office manager or COO. These are all aspects of the company that, ultimately when you build out your chart of accounts, which is basically like the buckets that all of the transactions get categorized into, when you break that out, you want to be able to see, okay, this is what our direct labor was, and then this is what our overhead labor is as a percent of revenue. Without breaking that out within your financials, you really have no view into how efficient each one of those are operating for the company. So definitely recommend making sure that within your chart of accounts, those are separated, because without being able to see some of that structure and having that foundation set, it doesn't allow you to analyze it and dig deeper. And that even goes for a lot of the other aspects of the financials as well. Whether it's making sure you have a clear gross margin number, and so that way you can see, okay, how well is our team performing in the field. In regard to overhead salaries, it's important to think of this more based on total revenue that the company has, and how much based on the revenue can the company actually afford when it comes to paying out overhead salaries. Can a $500,000 company afford a full-time office manager? Right? Can a $5 million company support 5 overhead staff that don't help with any work on the projects? Right? So those are things that, as you look at your financials, base it off of revenue, because as Mike Callahan went over before, there's things like software and automations and different things that can be built in. And before you look to add someone, always think, okay, is there a software that can help solve this? Is there a certain process that we can implement? Or is that step within your company even necessary, right? To make sure that you're fulfilling the core services in your company. Also, make sure that you're matching what that administrative team member's expertise is and what their expertise level is with the appropriate tasks. Similar to how when you might purchase a great piece of equipment, but at the end of the day, are you using it on the wrong kinds of projects? So this is something, especially when you think about overhead salaries, if your management level team members are handling tasks that an entry level person can handle, you're technically losing money in that scenario. So that's something to really focus on as well. And the main role of overhead in general, and then overhead salaries really being the biggest expense within your overhead, is to support the core operations, right? That is their entire goal. Their goal is not to do the work on the projects. Their goal is to be there as a support. And there is such thing as being too lean or not having enough overhead staff, especially when you don't have the systems and the software to actually make sure that things are operating the right way. Typically, for when it comes to overhead salaries, so again, that's anyone who's not actually physically touching the work on the projects, you're looking at around 8% for more of the installation-based companies, and then closer to maybe 10 or 11% when it comes to the reoccurring maintenance type companies, less material-intensive companies. So looking at that as a rule of thumb, so $1 million company, you have a bucket of roughly 100,000, right? $10 million company, $1 million. $500,000 company, around 50,000, right? So when you're smaller company, it could be mostly yourself handling all that stuff. But again, if you decide to hire a full-time office manager before you can technically afford it based on your revenue size, you could do something like that, but then it's more pressure, and it makes it even more important for the company to generate revenues in order to support that. And ultimately, again, going back to what that plan looks like for 2026, if your overhead was inflated in 2025, it's making that decision, right? Are we going to maintain a lot of the team that we have and try to really support the operations moving forward and generate revenue in order to support that? Or are we going to make certain cuts? And sometimes we come across that with companies that we work with, where there's that realization of, maybe, it sounded like the right thing to do, right? It might have sounded like the next step of running a business, right? Getting a facility space location, hiring in office management level people to do different tasks. I think something that we see sometimes is, certain internal team members, and we work with some phenomenal ones, which that's a whole nother story. But, I think it's, the same way that you obsess about the work being done on the projects and holding people accountable, showing them what success looks like, making sure that they're being efficient, that there is those standard operating procedures set up. Put that same focus when it comes to your administrative team as well, because you don't want to, you don't want that to be where your waste is. And anytime, whether it's overhead staff or just any overhead cost in general, always think twice before you incur that, because ultimately that's not directly generating revenue for the company. It's more of there as a support for your operations. And then what this turns around to is this also becomes a competitive advantage for the company. Now you're able to manage this well, implement systems in your company, software, making sure that your administrative team and your operations team are on the same page, flowing very nicely. Now, when you go out and do a bid for a project, you're operating at 28% overhead. Your competitor is operating at 37% overhead. Now you build in an estimate for the same profit margin, and now you could potentially get the job because you're able to price it lower, right? Because your overhead is not inflated. So again, look at it as a competitive advantage. We truly believe that dialing into the numbers like this is where you can really, things get really interesting, because you can really, build that confidence with your pricing structure and make sure that you're putting yourself in a position where you can succeed. So, and if anyone has any questions on that, definitely let us know. And also, before we move on to the next speaker, just want to thank everyone for joining us here today. A special shout out to Cycle CPA clients, because without you, we wouldn't have the time and the resources to invest back into events like this. So we really appreciate the opportunity to do business with you. And if you're sitting there not a Cycle CPA client, we don't hold anything against you, but it's you can always reach out to us if you have any questions as well. But again, just want to thank you, and another thank you to the speakers, which we still have a few left here as well for today. But just wanted to mention that here.
Yeah, love our clients and everybody that has attended here. And if you don't mind, Joe, I just want to share my screen onto a budget spreadsheet. Not that we need another budget spreadsheet, but I just want to kind of drive home a point here in regard to the overhead expenses. So let me just share my screen real quick, and then you all can tell me if you see it in the chat, if you're able to see my screen. Oh, there it goes, popped up. All right, so as Joe went through, you'll have your, let me zoom in a little bit better so you guys can all see. You have your overhead budgets, right? For each month within that next year. And you could split it up between fixed and variable costs. And your fixed costs are, first of all, overhead expenses are items that are not directly related to that job. right? So think of things like telephone. You can't trace that back to a job. Rent, overhead salaries, like Joe mentioned, right? And fixed, what fixed means is that this expense is not really going to increase and then decrease every month. It's pretty much the same, right? And so, your rent's going to stay the same. Overhead salaries, they're probably on a salary basis, so that probably stays the same, and so on and so forth. And then variable means that as your revenue goes up, advertising is going to go up, right? It's going to come down, stuff like that. So just, budgeting for overhead costs, but not only that, so this is the company-wide budget for overhead costs, but then splitting it up between divisions. And I know day one yesterday, somebody spoke about this. And the reason why it's important to split up your budget by division, if you can, and if you have the information to do it. Sometimes when you're just starting off, it doesn't make sense. But if you're an established company, or if you've been in business for a few years and you kind of have your division set, it definitely makes sense. And I'll tell you why. So here in column O, we have design build. Column P, we have maintenance. Now, one of the biggest differences that I see off of the bat is this design build number here, 226,000. Maintenance only has 30. Now, what is that? That is the overhead salaries allocated to those divisions. What does that mean? It means that for this company in particular, they had more managers, supervisors working in their design build division than they did in their maintenance division. Okay. And as you can see, though, for the company and for all companies, really the most heavy or high product line item is probably the overhead salaries is what's going to make up a lot. So out of this 257 for the entire company, 226 actually is allocated to the design build division, and only $30,000 is allocated to the maintenance. Now, what does that mean for your company and for your pricing and your estimating? That means that your overhead rate per hour, the amount of overhead that you have to recover for your design build estimates, is much higher than your maintenance. Here we have it almost as close to $25 an hour that I have to recover for my overhead for design build projects versus my maintenance. I only need to recoup $15 per hour for my maintenance division. And if I get an average of these two, right, it would be almost $20 an hour company-wide, right? So now, if you were to use a blended rate, what are some disadvantages of that? First, I think that you would probably maybe lose out on more contracts or bids for your maintenance contracts, right? Because instead of bidding it at $15, not at $15 an hour, but for the overhead recovery at 15, now you're doing 20, right? And for your design build, those services typically you can bid at a higher revenue amount, which you could allocate the $25 per hour to. So I think that the sooner that you can build it out by division, the better. And if you're sitting there and you're like, hey, my managers work in both divisions, how do I do that? What we do is make an estimate. So if we have a manager that works on both divisions, we say, okay, well, do they work on the divisions 50-50? So we allocate 50% of the salary to one and then the other, or is it more of an 80-20 split, 70-30, whatever that becomes? But even though it still becomes beneficial to split that out for that reason. But just wanted to share that pretty quickly with you guys. And
and it's
you get over.
And it's worth doing that allocation because, like Carla mentioned, the overhead salaries is the largest item within overhead. So it's worth taking that extra step, especially when you have different business models between the different service lines. You want to make sure that you're being honest there. But awesome stuff. And again, these are the not so exciting things about budgeting, but it's it's important to really dial in as we think about next year. And one of the other aspects when it comes to some of the decision making is building and managing a fleet, which our next speaker, Renee Milam, is going to dive into. And originally heard Renee actually on Tommy Mello's podcast. So Tommy runs a home service company, massive company, and does a fantastic job. And so that's where I was first connected with Renee, and a lot of it that she was saying really made a lot of sense. I really wanted to bring her on here because I think it's also one of the kind of less talked about items. So really want to thank her for taking the time. We really appreciate it. And so she's a fleet management expert with JumpSpark, working with contractors nationwide to reduce equipment downtime and gain control over maintenance, utilization, and costs. She helps contractors implement efficient fleet systems, strengthen safety compliance, and make data-driven decisions that improve productivity. Renee's solution-focused approach empowers owners to run tighter, more reliable fleet operations that directly improve profitability. So again, really want to thank Renee, and we'll let her take it from here.
Hi, everyone. My name is Renee Milam with JumpSpark Fleet Management. I'm excited to be here today to be part of your webinar and kind of share with you all the benefits to working with a fleet management partner like us. There's time-saving benefits. There's money-saving benefits. We're really, our goal is to be your one-stop solution when it comes to everything fleet-related. You say, why would I work with a fleet management partner? It's our expertise. We are going to give you more information just to help you make better decisions when it comes to managing your fleet of vehicles, because we know it's a very time-consuming project, right? And vehicles is the third largest expense when it comes to a business. So it really can impact your bottom line either positively or negatively. And hopefully by partnering with us, we're going to help your fleet impact your bottom line positively. But just a little bit more about us. And I wanted to thank Joe for allowing me to come here today and talk with his Cycle CPA clients. It's something that Joe had listened to, had known about it, and he thinks it's also something that would be significantly advantageous to his clients. So that's why I'm here as well. But let's talk a little bit more about JumpSpark. Been in the business for about 30 years. We help all different types of commercial clients. It doesn't matter whether you're in the home service industry, whether you're in the construction industry, mining industry, or even the landscaping industry. If you need a vehicle, JumpSpark Fleet Management can help really make a turnkey type solution for you, from everything from acquisition to upfitting to wrapping it, so that when it gets to your location, it hits the road ready to go to help start generating revenue for you. So I just want to share a little bit about how JumpSpark got started. Some of you may know Tommy Mello, may follow him from his home service expert podcast, but I met him several years ago. He has been leasing his vehicles for A1 Garage Door for many years, but he'll also be the first one to tell you he had made mistakes in the beginning. He was buying used vehicles and running them into the ground, thinking that, he was saving all this money because he wasn't spending as much on the new vehicles. But what he actually found out at the back end was that, his brand image wasn't very good. His drivers really didn't enjoy driving an old beat up vehicle, and they didn't take care of them either. So once he started leasing vehicles, because of that, it allowed him to fleet up very quickly. And he was able to grow A1 Garage Door into a multi-million-dollar business. And leasing vehicles really helped him do that, right? It takes a lot of capital to buy vehicles. And by leasing them, that just allows you to take that capital and use it somewhere else within your business. 2, how does a partnership get started? I mean, typically it starts with a line of credit. We get you approved for a basic line of credit right around $300,000. And we use that line of credit, like I said, to source the vehicle for you. So there's no more having to go to the dealerships. There's no more trying to find, the right vehicle. There's no more going there and spending hours waiting for the finance department to get all the paperwork ready. We handle that all for you. And then also what makes us different than going to the dealership or just paying cash is that we care about your fleet wellness, right? We care about you maximizing resale at the right time. And maximizing resale at the right time, there's a lot of information that goes into that. So that's why we have all that information, and our goal is to provide it to you to help you make better decisions. And it's tailoring it to what you need, what your upfit, what your rebranding might be a little bit different than the other clients that we have. So ideally, what our goal is to sit down and talk with our clients, figure out what they need, so that when they do reach out to me going forward, I'm going to make that a very seamless, turnkey process. You can tell me what you need, and rest assured, I'm going to make it happen for you. But we are a full fleet management company, so we have many other services that we can offer. Right? We have maintenance management programs. We have fuel card programs. We have cameras, telematic programs. We even have a full remarketing department. Right? So not only can we help you sell your vehicle at the right time, your lease vehicle, but we can also help you sell some of your used vehicles at this point in time. And we can use that anticipated equity as, say, a down payment going forward into a new vehicle. Or maybe you want to do a refinance. If you have $300,000 or $500,000 line of credit that's on your business or on your personal credit that you want to get rid of, we can help buy those vehicles from the lender and then refinance them back to you through a lease. And that's one thing I kind of want to get into a little bit deeper dive about is leasing versus buying. I kind of talk about that line of credit that you get. The great thing is that line of credit has no credit reporting. So right now, if you currently have 5, 10, or how many vehicles, on your credit posing as debt, this will be removed. So there's no credit reporting. So no longer will this $500,000 line of credit show up and impact you negatively. There's lots of tax benefits to leasing. One of the reasons that Joe wanted me to come on and talk more about this, when it comes to tax write-offs, you actually get larger tax write-offs by leasing than by financing. All right. On a lease, you can actually write off the entire 12 months worth of payments as an expense. Or on the opposite, you can utilize these as a capital lease, and you can actually take bonus depreciation in that year through Section 179. So more tax write-offs. There's portable equity. At any point in time, if we have to sell the vehicle, that equity that's available after we sell it is yours. It doesn't go back to the leasing company like a traditional lease. So best practice is we're going to take that portable equity and we're going to roll it into a new vehicle tax deferred. So now you've just bought down your next payment on your new vehicle because you have an automatic down payment from the other vehicle, that down payment that doesn't have to come out of your capital as cash. And then tax savings from a sales tax perspective. Lots of states, when you lease a vehicle, you don't have to pay the upfront sales tax, and you don't have to roll it into the lease itself. And since we're a tax exempt partner, you won't have to pay any sales tax on upfitting or on the graphics. And that's typically why when you look at an open-ended equity lease, the monthly payments are typically lower for several reasons, right? If you're going to compare apples to apples, you're going to be able to not have to roll sales tax into the lease, which lowers the monthly payment. You're only going to pay interest on 90% of that capitalized amount. Because with the lease, we don't have to write it down to zero like you do with the finance. With a lease, we leave a 10% residual at the end, what we call a balloon payment. That way, you're not paying interest on 100% of the capitalized price. So lower monthly payment by not rolling in sales tax, lower monthly payment by not having to pay interest on the entire amount. And then also there's no wear and tear charges, there's no mileage penalties, which what typically comes with your typical lease. There's none of that. These are open-ended commercial leases so that you guys can benefit from the equity at the right time. So if I haven't already made it clear, the three main reasons why you should lease a vehicle instead of buy or finance. One, conserve your capital, your cash. Use it somewhere else throughout the business, right? Or let it make you money instead of putting it into a depreciating asset. Two, larger tax write-offs. Your CPA will tell you larger tax write-offs means less tax that you have to pay to the government. And three, just lots of flexibility, right? There's nothing that says that you have to hold on to this vehicle through the entire lease term. If for any point in time we need to sell a vehicle for whatever reason it is, we can sell it, and we simply take what we sell it for minus what you owe, and then you either take that equity back as cash, or maybe you even decide that you want to pay the vehicle off early and continue to operate it. That's your choice with open-ended equity leases. They're very, very flexible. Getting qualified for one is usually typically a little bit easier as well. But what I do want to tell you is that if you want more information, you want to learn more about this, I would love to schedule a one-on-one time with you. You can simply go to jumpspark.com, our website. You can submit a lead submission, and you can actually book a meeting with me via my calendar on that, or my information will be with Cycle CPA as well. Simply reach out to your account manager and they can put you in contact with me. As I mentioned, I'd love to learn more about you and what you guys are doing with your current fleet to really help provide more information and more expertise on ways to help you save money and save time when it comes to your operations. Again, thank you for allowing me to be part of your webinar today. Thanks again, Joe. I am available for any questions after this. Thanks so much.
Awesome. Thank you so much, Renee. That was phenomenal stuff. I received some questions in the chat. So please, if you have any questions revolving around that topic, definitely reach out to Renee. Also, her website, jumpspark.com, great resource there. And really appreciate you taking the time, Renee. Thank you very much. And we spoke about marketing a few times. But it's important to also think about, when you're looking for someone to help you out with marketing, setting realistic expectations for return on investment when it comes to that, when it comes to working with a marketing partner. So that's why we're going to bring in Aidan Silvers as our next speaker. Aidan is the founder and CEO of Green Marketing, specializing in SEO, Google Ads, branding, and website optimization for lawn and landscape companies. He focuses on data-driven marketing systems that turn online attention into profitable jobs. Known for simplifying complex marketing topics, Aidan provides clear, actionable steps contractors can use to increase visibility, improve lead quality, and build a consistent pipeline year-round. So super excited for Aidan to join us. So I'll go ahead and kick it over to him.
Okay, very excited to be here. Thank you so much to Joe and Carla. Amazing people, and we love the relationship we have with them. My name is Aidan, and today I'm going to try to bring you some value around setting proper expectations when you work with a marketing agency or anyone who's doing your marketing for that matter. It's really important to set realistic parameters, and just like any relationship, who's doing what, and are we in agreement to that? And so I think we all know this in our heart, but we let people sell us into believing things. So, what is important in marketing? What's really important is the sales and the money that we get from it. If we're going to invest 10 grand or 20 grand for the year, we want to know that we're going to make money back on that. And so, above all, right out the gate, please remember when you go into a relationship with a marketing provider, the number one measurements of success that you should be looking at with them and the measurements of success they should be giving you is sales and leads, specifically attributed from their campaigns, what they generate for you, not your overall growth. And the way that you're going to track that is via tools. There are tools out there that exist. My agency uses What Converts. That is one of the tools that is more popular, and it allows you to track every lead that comes in, the source that it comes from, and it allows you to see the journey. So, they came in from a Facebook ad, you quoted them for X amount of dollars, and you sold them for Y amount of dollars, right? And if you don't have that attribution, then you're really just kind of guessing. You're mixing all of these marketing efforts into a bucket with your referrals, your word of mouth, your organic growth. Maybe you got a really big commercial contract that contributed to a 20% increase for the year, right? So you have to be very careful with measuring these things and giving the agency credit to make sure that things are just transparent. And in regards to your ROI, you're going to want to kind of poke the agency a little bit or the provider and just see what their expectations are on success. Like, what does success look like? And I hear a lot of companies say, yeah, I'm doing great. My ROI is double. So I put in 20 grand for the year and I made 40 grand. That's awesome, right? And agencies will have you believe this to be true. But what you're really going to want to do to understand your true ROI is look at your net profit margin and then use that as the floor, the minimum. So if you invest, 10 grand for the year and your profit margin is 25%, for example, for the year, that means you need a 4X. You need 40 grand for the year just to break even. This is your break even point. Anything below that is losing money. So, and obviously you're here to make money. So a 4X really isn't even worth it at that point. You need to have more like a 8X, a 10X. Our average at the agency is 8 to 12. And we're pretty happy with that. There are people that do more. There are people that do less. But what's important here is to understand what is the minimum that we need to hit. And the agency really should be telling you these things, right? If they're not, it's probably because they're trying to avoid it. And when we think about ROI, this is your total budget and the return on that. So what you pay the agency plus your ad spend. But you also want to understand your ROAS, which is your ad spend specifically, your return on ad spend, right? So let's say you're investing $2 grand a month into Google Ads. Let's get even more specific because there's several Google Ads. $2 grand a month into PPC, 1,500 into local service ads, 1,000 into Facebook ads, right? So that's what, 4,500 a month in ads. And what's important is, where's the ROI? What is the ROI on that ad spend per platform? If I'm putting, $2 grand a month in the PPC, I'm going to want that again to be a 4X at the very minimum for that platform specifically. So I need to see eight grand a month coming in from that to justify the spend. And when you track per platform, you're able to see like, oh wow, we're getting a 20X on local service ads and only a 5X on Meta or Facebook ads. So what is the point in putting the ad budget into Facebook ads, right? So if you don't have these metrics being tracked, again, with attribution from tools, then you're just kind of guessing. And the agency typically is going to ask you, like, hey, what's going on? What's working? And obviously, you don't know. That's what the agency's job is to do. So you want to make sure that you're able to track sources, sales, ROI, and ROAS as well. And without this data, it becomes very difficult and very murky. And agencies, they want to keep it that way because then it's, a little easier to fool you into this idea of like, hey, we're having success, right? Look at your year-over-year growth. You've went up 20, 30%, or you doubled. But in reality, perhaps they've contributed nothing to that. Maybe that's just your own organic growth, right? And your skills of scaling a business. We want to see the agency's results. And so transparency is super important. Whether the results are good or bad, you should be able to see that at any moment on your own without a report, right? You should be able to log into tools and see the stuff. And so ask for proof. This is a very important credential when you're considering someone to work with. Ask for the proof. Where's the case studies? Where's the success stories? Where's the screenshots of this data, right, of sales and leads and things like that? And give me some real evidence of success, not just like vanity metrics, right? And what this all comes down to is the expectation being set up front and then the actual experience, the actual result. So it's very important that you ask questions to clarify and to set the tone because a lot of agencies are not going to do that. They're going to try to sell you. They're going to try to promise you the moon, and right? And that's just not setting you up for success. Having good expectations in place, just like any relationship or marriage, essentially, it's like if we're going to be together for forever and we're going to have kids and a family together, like, who are you? What can I expect? What are we going to do when we argue? How are we going to, take care of the bills, and who's going to be in charge of what, and what can I do to serve you, and vice versa. So having good expectations is just critical. And any agency that is not doing these things is a red flag, right? So here, we got just a picture of a red flag, not really any bullet points or anything. It's because everything I went up to this moment, if they're not doing this stuff, it's a huge red flag because it means they are shying away from the truth, right? And transparency. Whereas me and my agency, we love that because when we are able to get this data, it is the most undeniable evidence of success. And I don't need to sell you and pitch you. I just need to pull up some data and some screenshots and give you videos and success stories and phone numbers to people that you can call up that work with us. And it's real and it's raw and it's not vanity. It is money. Like, can we make you money? Yes, we can. And here's the proof of that. Anybody who isn't showing those things to you, well, these things to you, is likely trying to operate in a kind of misty, foggy way without full transparency. So I have to wrap it up here and limited on time. But what I'm going to end it with is, just stay true to what you know and what you believe to be true, which is I'm making an investment into a agency or a provider to grow my business. And I need to see you grow my business. I need to see tangible data, metrics, reports, and I need to see metrics and reports for things that are not vanity. I don't want to see impressions, engagements, etc. I want to see number of leads, qualified leads, have you, and I want to see sales and quotes. I want to see how much I quoted for these leads, how much I sold for these leads. And I want it to be very specific to what you generate for me, not everything I get, not my referrals, not my word of mouth. And when you can do that, you'll be able to identify who is helping you grow, who is helping you, who is serving you and your goals, and is not just there to collect the paycheck. All right. I hope this was valuable to you. If you have any questions, feel free to reach out. Aiden Silvers. I'm an open door. Happy to give feedback, audits, just value, right? Value for free. I love what I do, and I love this industry in specific. So hope you guys have a great Happy New Year. Merry Christmas to all of you. We'll see you later.
Thank you very much, Aiden. Great presentation there. Incredible guy as well. What'll happen if you look at all aspects of your company like that, based on the numbers. And I know people like us, the accountants and looking at the financial perspective, I think that's what we think about a lot, but definitely make that more of a priority. And I want to thank Aiden again for highlighting that on the marketing side. I think it's incredibly important to make those data-backed decisions. So thanks again, Aiden. I shared his website as well in the chat. So phenomenal stuff. And excited for our next speaker. So we have two more speakers for today. This next one is Andrew Latursky, and he's going to be covering identifying and covering your fixed and variable costs. And he's the founder of the Ultimate Landscape Academy, a coaching program designed to help contractors fix the operational, financial, and cash flow challenges that limit growth. With 12 plus years of experience as a landscape designer and CEO of his own company, Andrew learned firsthand how to build a company's financial backbone and implement systems and drive sustainable profitability. His mission is to help owners eliminate chaos, strengthen overhead structure, and build businesses that support both long-term goals and personal freedom. And that personal freedom thing is so important too. I think that's what we're all striving for, and everyone has the different mission and different whys behind what you do. But I think always looking for it to be help to fulfill the personal side of your life as well. So want to thank Andrew for joining us, and I'll let him take it from here.
All right. Hey, everybody. I'm Andrew with the Ultimate Landscape Academy. And today you've been here either already listening to a variety of other people speak about overhead and how it pertains to fitting into your business. Or if I'm the first one, then welcome. You're going to hear even more after me. So now, getting into overhead and understanding what it is, likely you already have a pretty good understanding, but at the end of the day, our overhead is something that's not going to be directly tied to actually providing the service, right? We're not talking about what's going to the job site. We're talking about what it takes to run the business, or what's not tied directly relating to providing the service. So today, I'm going to make two promises to you guys, and I'm going to keep this quick. Number one is I'm going to give you a new way to price, or at least a better understanding on how you price, keeping in mind how overhead actually blends into it. And number two, I'm going to give you an understanding of a few items that need to be built into your overhead so that you yourself can actually make sure that they're being covered by each and every customer, and you're retaining really good net profit margins at the end of every month. All right, let's get into it. I'm going to share my screen with you here with a little whiteboard that I've already started. Let's open it up here. All right, so first of all, like I said, I'm going to talk to you guys about a way to price so that you can be more effective. Let's talk about it for a minute. When we look at our pricing, what does that include, right? Well, very simple, there are three things, and that's all you need to worry about when it comes to pricing for any project, whether or not it be lawn care based or actually project based work, okay? Number one, you have to take care of your fixed costs. That's over here, all right? Now, fixed costs very simply mean our overhead, and we're going to talk about those items today. We have our variable costs. These are what goes into each and every project, the actual time it takes to install and the materials that are going to go into it. And then lastly, my favorite part, and it better be yours as well, is the profit. When we add all three of these things in, we get the price, all right? Now, very important before we get into these things is to understand is that if you again end up in a situation where a customer says to you, hey, thanks for giving me a number, but can you do a little bit better on the price, right? We've been there before. I want you to understand that that comes from one of these three categories. And I'll tell you right now, your fixed costs, it's very hard not to pay those. If all of a sudden you stop paying some of your overhead, people are going to be asking you or sending you notices that you're in default of payment. All right. Now, your variable costs, your material and your labor and other things that go into completing the job, it's going to be very difficult to discount your team members. You can't not pay the guys, right? It's going to be very difficult to not pay suppliers. Again, you're going to get notices, people are going to quit, doesn't work. So what does that leave? That leaves only one area, and this is your profit. And this is why reducing our price just to land the job really hurts the business long term, because it takes away from the number what's left over, which is the amount we have to actually push the business further ahead. Okay, profit's the number you put in your pocket. Profit's the amount that you get to reinvest if you want growth. Now, let's get into these things so we can talk about each one. Okay, now, number one is admin salaries. I want to make sure that we get this one selected here. Admin salaries is going to be something that falls under our fixed costs, right? Whether or not you go to site that day or your team goes to site that day, your admin is still coming into the office. They're still doing, answering the phones. They're still doing the paperwork in the back end. They're scheduling things. They're ordering materials, whatever it may be. So your admin salary is something that needs to be covered on every single job that you do. And it's not a proportionate value. This is a bit of a trap that some people will end up in, and they say, well, I need to build exactly 8 hours to this job because it's a one-day job and that's my admin's time. And I need to build this many hours to this job because that's the admin's time. And you end up in this spot where if you have a down day or you have something come up or the team, is short, they get done sooner or whatever it may be, you change your pricing, you end up with not enough money to cover your admin. And we've just talked about that, is that you can't change your admin costs. You can't change your variable costs. The only place you can pull that from is your profit, right? And this hurts the business long term. So what we want to do, and by the way, we're going to do this with all of these things here below that fall under our fixed costs, is that when we calculate all of our fixed costs, and we use an overhead calculator here, it's the same one I used in my business. I started my business. It's been 6 years since I've been out of the industry as far as install goes, but I ran my business for a decade. I started it from the ground up, and I went through season after season of feeling stressed and tired, and I finally hired an admin, and then there wasn't any money, right? It was always this stressful part back and forth. So if you feel like you're in that right now, and you feel like your time's totally jammed up between the installs and customers and everything, and there isn't the money to move forward, this is probably the issue that you're having, and exactly what I found is that I couldn't figure out how to calculate my overhead in its entirety and then how to charge it to each job. So what we do here, and what I recommend to anybody that I work with, is that you figure out your annual overhead. What does it cost you to run your business for an entire year? From there, we extrapolate the number of days or working days you have in a season. So let's just take a random number and say it costs you $200,000 a year to run your business. This includes all the salaries, some of the other things we're going to talk about in a minute, all of the fixed costs of running your business. Now, at the same time, let's say you have 200 working days in a year. Pretty simple math here. Anybody can understand that it will cost you $1,000 a day to operate your business. There's your fixed cost number. That's the number that you can utilize when you do your pricing. If it's a one-day job, you add $1,000 in fixed costs. If it's a 2-day job, you add $2,000 in fixed costs, and so on. This is the way that we account for all the expenses that are going to actually come up into our business and make sure they're being covered throughout the season. Now, before you say, well, what if something comes up mid-season or, something breaks down and we don't have the money, right? Well, this is where you do need to adjust this on the fly throughout the year. If you're doing your proper bookkeeping and staying on top of your numbers, then you'll be able to add this in and then adjust that fixed cost as you go. Now that you have an understanding of how to utilize this and how to build it in, what other stuff do we need to build into our fixed costs? Well, telephone. right? That's another thing. The cell phone still has to get paid every single month, or the work phone every single month needs to be part of our fixed costs, right? Again, if you're covering the cost of a phone for any of your team members or the office phone or anything else like that, again, all part of the fixed costs that need to come out of the fixed cost category and not your profit category. These are two very specific parts. If you have them together, then you don't have clarity on every single project that you do. Now, outside of that, things like our rent and our lease, those all need to be accounted for, right? We can make sure that we're paying for our shop rent or our office lease, whatever it may be, so that those bills continue to get paid and we don't get evicted. Now, one thing that I get asked by contractors who are starting to scale their businesses is they will say, well, listen, I'm going to need to rent a shop later this year, or I want to hire an admin later this year. Well, it's really simple. When you build out your annual overhead, you will add in the cost of the new shop. You will add in the cost of the admin salary. Whatever additional thing you want to add in that season to your business, we're going to be able to build it in, or you can build it into your fixed costs. And then that way, when you go out and you quote on a job, you get the job, you now know that you've built in an admin salary to that project. You can set that aside over the course of a few months if you really want to build a buffer. And then when you hire an admin, you've already got a few months of their salary stacked away. All right. Same thing with the new shop, anything else you want to purchase. Now, utilities, they fall into this same category here, right? Utilities, we're going to have to pay for electricity or gas or whatever it may be for our office as well. These all fall in under, again, that fixed cost overhead category. Now, one thing that, again, I'm going to test you on here, and hopefully you've been paying attention, is labor, right? Where does labor go in all of this? I'm hoping that you're going to say variable costs, because labor changes, right? If the guys don't go out to the job site and they're being paid hourly, well, then we don't need to recover that if they don't go to the site. That's why it's part of our variable number and not our overhead or our fixed costs. Now, at the same time, materials is going to fall into that same category as well. And there are a variety of a few other things that go in under your variable costs. My simple rule of thumb is ask yourself, is this something that is needed to run the business, or is this for a specific project? If the answer is specific project, it's a variable cost. If it's to run the business, it's your overhead or fixed costs. Now, the other two things that I want to touch on today too are office supplies and software. Now, this includes things like your CRM. This includes things like your internet subscription, if you have something like that goes into software for how you run your business, any design software you have. And then obviously at the end of the day, your office, you need supplies. This would be letterhead. This might be branded folders. If you have a design folder that you give to a customer, be part of your office supplies. Something that you take from the office that you need, again, pens and paper clips and paper and all that stuff that goes into running the business that you need to take care of things in the office. Okay. And then the last thing on my list today that I want to go over, because again, I said I didn't want to take up too much of your guys' time, is small hand tools and small hand tool depreciation. Now, small hand tools, obviously you may say, well, I need them for a particular job. And if that hand tool is only ever going to be used one time and that's all it's ever good for, then that goes to your variable costs. Absolutely. If you are buying a special drill bit to core through a concrete step for a utility line or something, and you know it's a one and done and I'll never use it again or it'll wear out, then it goes under your variable cost. But what you want to make sure you're covering here, and when I say the small hand tools and the small hand tool depreciation, is that your shovels, your rakes, your levels, all the stuff that goes in your brick boxes, if you're running maintenance crews, you're going to have other things like that. You may have gas cans that eventually wear out on you. You may have, again, rakes or certain gardening tools that you're using, edgers, things like that. These things are eventually going to break. They're going, the guys are going to snap a shovel, they're going to break a rake, a level gets banged up. We have to come up with a number, and this is a guesstimate. This isn't going to be one of those things that you can go to a P&L and find the exact number off of, but you can go back and look over last year. You can take an inventory of last year's expenses, say, hey, how many small hand tools did I have to buy that were in replacement of other ones? Let's just say, for example, you spent $100 a month on buying new rakes or shovels or levels, and that worked out to be $1,200 for the year. Well, when you're filling in your overhead costs and you're calculating your daily overhead, you're going to be able to put that amount of money in per month, which will show you your overhead for the entire year, extrapolated out. And then moving forward that if I'm $1,200 for the entire year, and I'm going to divide that by my 200 working days, that I need to put that much per day in my overhead for the levels, the rakes, the gardening tools that the guys break and need to be replaced. This is a really good way for you to be able to avoid burning, my favorite part, like I said before, burning our profit with replacing things in the business that don't make it more money. Okay, replacing a rake doesn't make us more money. Replacing a level doesn't make us more money. We don't want to get sucked into the spending money from our profit, again, my favorite place, to replace things that should be accounted for in our fixed costs. Now, at the end of the day, if you don't require all of these items and from one year to the next, the guys are better with the equipment and they don't break as much. Well, you can lower that amount, or you get a little bit of a bonus and a bump in your profit margin. On the other side, if you don't account for enough in your overhead, which again, this comes back to tracking it throughout the year, then you're going to lose a little bit from your overall net profit margin, and then it's going to handcuff you and choke out some of that profit long term. All right. So I hope you can take this right now and look at your business and say, is this how I'm pricing? If not, try and wrap the way that you're pricing things into this model right now. Figure out your fixed costs of running your business and then come up with your daily rate. Some guys use man hours as well. Both ways work for it, so that you make sure that all the expenses, and again, we only covered 6 different things today. You're going to hear a bunch more about these, and maybe you've already heard of a few of them throughout this webinar, and you're going to be able to add these all together, because in every single business that I've ever looked at, including my own, I have seen massive profit leaks. Every single one, no matter how good people are doing, there are profit leaks in their business, and the majority of them, and I'm talking 10 to 20%, come from fixed costs, right? Most of you understand how to calculate your labor. Most of you understand how to calculate your materials. You've had a lot of experience with this, but it's the back end stuff that is costing guys the most amount of money. It's what's causing the strain, the stress, the frustration, making it feel like you have to get back on the job site to try and get a job done in time so you have a little bit more money left over at the end of the month. So take this, run it through your business right now, really come to terms with this so that you can list off any particular item, whether or not, it be the salary or the telephone or something completely different that we didn't talk about here today. Run through this and be able to understand that this understanding is what's going to take your business to the next level. It's going to release some of that strain, that stress, those cash crunches that make you just want to burn everything to the ground, say, I'm giving up and I'm doing something different. So take this, implement it in your business, and you'll watch your profit margins get better. You'll have money to reinvest, and then you'll actually be able to take the business to the next level, which if you're on this and you're watching, I'm guessing most of you are looking to do. Thanks for your time, guys. Hope you enjoy the rest of the webinar, and you get to learn a lot more about overhead and how it helps with growing your business.
Awesome stuff. Thank you, Andrew. That was some great thoughts there, and really appreciate you taking the time as well. And I included Andrew's website in the chat too, and super excited to welcome our final speaker of this 2-day series, and couldn't think of anyone better to close us out here. Brian Fullerton, and he's going to present on No, I Can't Do Better on My Price, and Here's Why: The Power of Knowing Your Numbers. So Brian is the founder of Brian's Lawn Maintenance and the creator of Lawn Entrepreneur Academy, one of the most influential education platforms for lawn care entrepreneurs. He also hosts the Fullerton Unfiltered podcast and runs an industry-leading social media and YouTube presence, where he shares equipment insights, business systems, and real-world lessons from the field. So really want to thank Brian for joining us here, and I'll let him close out the event.
Hey, what's going on, Cycle CPA family? Excited about hopping on in here today with a quick presentation. Carla and Joseph asked if I could share a little bit more about our numbers, our pricing, and really how we are tackling our bidding process, especially when it comes to our commercial sites as we grow our company, Brian's Lawn Maintenance. Very honored and excited to hang out with you guys today. Joseph said there was something like 1,500 people registered for this event. I'm going to be watching the chat here as we continue this conversation, but very honored to be with you guys today. Hopefully you guys are getting a lot out of this morning and this afternoon session. I know I am. I'm watching right now real time from my plow truck as we have basically a 12 or 14 hour snow event up here in Michigan. I know a lot of you guys are getting snow across the Midwest, which is exciting. But nonetheless, here's what I want to talk to you guys about today. I have a quick presentation and the title is No, I Can't Do Any Better on My Price, and Here's Why. And this is about the power of knowing your numbers. I'm going to share with you guys for just a few minutes about why, when you're bidding a commercial site or even a residential site, you should be sticking to your price and why you should be firm on the number that you're delivering. And really, that truthfully stems from knowing your numbers, knowing your costs, knowing the profit you're trying to make, and having a macro game plan with your business, as so many have said on the webinar before, and I guarantee you are going to be sharing about after. Now, I've got some fun things that I want to do. I'm going to click through this next couple of minutes with my actual Element account to show you guys an under the hood look at how we run our business, our estimates, our templates. But then I wanted to show you, practically speaking, why we can't give up profit, why we can't lower our price, and why we do need to charge what we are to make sure that we're making the profit that we have for our business. You know, as I look at the chat here, I was going to say too many people and contractors especially are always apologizing for their pricing. You know, every spring we all get bullied into sharpening the pencil, lowering our prices. Oh, the other guy was doing a lawn for 75 bucks. So can you do it for 60? And it's just arbitrary, like race to the bottom. Sometimes, you know, if you guys are out there and people just keep beating you down, you start losing your confidence as you start bidding sites because, well, the spring rush is coming, the weather is getting nicer, you want to backfill, and all of your friends are winning new accounts and sites, and social media showing you everybody's highlight reel. And so you just feel like, well, maybe I'm just priced too high, and maybe I don't know what I don't know. And you start kind of offering this low bid price to some of those commercial or residential accounts. We're going to put an end to that here today. Now, again, everything starts with clarity. Everything starts with vision. Everything starts with having a game plan of what you're trying to accomplish, no matter the season, lawn or snow. So it has to start with that. And really, the clarity comes from your budget. And I know Carla and Joseph are just champions of that conversation, and the rest of the Cycle CPA team. I do get to work with Cycle CPA intimately. I love them. We have a great relationship with our account manager, Becky. We just hired Olivia for Cycle CPA for our taxes. So a quick little shout out to mention to those gals. Couldn't run our business and do what we do without them. So if you guys haven't quote unquote drink the Kool-Aid just yet, consider, you know, signing up with Cycle CPA and all that fun stuff. Carla and Joseph will take care of you. But what they really will help you do is hold your feet to the fire to build some accountability as you guys grow your business, to know your numbers and know what you're actually doing to price and bid that work. So let's jump into it together. And by the time this is done, I'm going to go through an actual bid with you guys and relay a conversation that just came in not only 4 or 5 days ago about a new account. It was a local car wash. And after, you know, coming in the front door and the customer was saying, hey, you know, emergency, we need snow and salt. Our last guy flaked out, which happens. I gave him my price. And, you know, naturally, he came back with a rebuttal. He said, hey, if you can do it for this number, we're good to go and we're good to sign up. And I'm going to go through that story right now about why I said, no, sorry, my price isn't going to be any better. Here is why. And I'm going to go through that whole conversation and price with you guys, or that whole conversation with you guys today about why my price couldn't change. Okay, so let's do this really quick. Let's jump into our account. First things first, I'm going to minimize this screen here for myself. And we got Cycle CPA up front. I'm telling you guys what, I have to just do it because if you guys have not signed up with Cycle or the Cyclescape reporting, as you guys get those quarterly reviews and those annual budget reviews, you are absolutely missing out. There's nothing more that I can encourage you to do than to get a quality bookkeeper and somebody like Cycle CPA a part of your team. That was absolutely the biggest transformational difference, my wife and I, financially in 2018 and 19. We hired bookkeepers to actually help us understand what the heck is going on around here. If you're doing 100 grand in revenue or more, in my opinion, you're absolutely due. Sign up with them and they'll take care of you. So I had to show Joseph's beautiful mug there. Let's keep going. Let's go into our LMN budget. I'm going to keep this tight and short and sweet. As you guys can see, we're operating off of our current 2025 budget. We're about to hit publish on our 2026 budget. And if you guys don't know, whether it's LMN or whatever software you guys use, or pen and paper, maybe you have a calculator that you did, or an Excel spreadsheet, whatever it is, it's totally fine. Different levels for everybody that's out there with different sized businesses. But you have to be able to go into your actual budget, and this is our actual budget, and you have to be able to project out the next year about what's your sales revenue goal, how much you're going to be spending on your field labor, how much you're going to be spending on your equipment, your materials, your subcontracting, and really the big one that a lot of people just don't account for, and I know I didn't for a long time, was the general overhead of the business. And in LMN, it's got some great colorful ratios that it can show you, red if you're too low or too high, yellow if you're about right, black if it's good, just general suggestions. We have all of our overhead baked into here. Then our account manager, Becky, helped us to clear this up with our chart of accounts, and we're entering all of our data in, so it's more accurate year over year. You can see our annualized profit if we stick to our budget, our pricing, and actually get the man hours in and the work completed, et cetera, right? So this is our budget. This gives us a macro of what we're trying to do for a sales number and all the cost to do the work. That then translates down to all of the costs for our 4 categories, for at least my business, that we're charging out for: labor, equipment, subs, and materials. And so you can see what we have for the general breakdown of my labor for landscaping. And in the summer, you can see our equipment breakdown, what it costs to run a truck or a crew per hour or per day. And this will all make sense in a quick second here. Same thing with our material markup. You can see all of our material, and this gets updated annually. And you guys have probably already seen all this before. Last but not least, the markup that we have on our subs. Okay, so when we look at an actual estimate, and I want to just take this from the top in case you guys were any confused on this at all along the way. At least in LMN, how it works is we're charging out for our labor, and we're charging out for our equipment. The unit cost is what it costs to run that piece of equipment or that labor to get the job done. When you add in all of the company overhead, you're going to get in LMN the unit price. So that is the cost to actually do the job plus the cost of the overhead. So your on-site guys and your on-site equipment and maybe even materials, right? That's doing the work. But then you have the cell phones for the company, the insurance for the company, the owner's salary for the company that just sits in the cool air conditioning office and doesn't do anything, right? Of course. And all the extra associated overhead costs. Those have to get recouped for every labor hour that's out, every equipment hour that's out, every ton of salt applied, every mulch yard applied or put down, et cetera, et cetera. So we have to recover that overhead. And you saw we had about $250,000 worth of overhead on $1 million business. When you take the direct cost of doing the job plus the company's overhead, you're going to get your unit price. Then you have to add your desired profit. Now, in Snow and in my system, we have some skewed gross and net. Overall, we have a blend of about 16% net profit for Brian's lawn maintenance. But you can see that once we add the direct cost, the overhead cost, and then we have our true net profit that we're trying to derive that also gets stacked to that price, you're going to see how we're able to start deriving our prices. It's very, very simple. Now, here's the deal. Without boring you guys to death, what we did on this car wash, and I'm going to show you guys a quick little photo here. You guys can see that there's this map is from Attentive, beautiful company, love working with Attentive, but we get all of our takeoffs or measurements, and you can see the blue and purple are snow, the pink are sidewalks, the green is mowing and grass, the yellow is shrubs, so on and so forth. So we get our measurements, we plug those into the production rate calculators at LMN, and long story short, it spits us out a price. And now here's the deal. Once we know our overhead, once we know our pricing, and we know our desired profit margin, part of our macro sales plan for the year, we now know what to charge. And of course, this sounds overly simplified. Simplicated. I don't know if that's a real word, but it is now. Overly simplified, and it's not complicated. It does take some time to learn. I'm not going to deny that. But once you have these core components in place for your recipe for pricing and estimating, it's just basically rinse and repeat. Now, when I took these actual measurements, and I'm not going to show you the whole site, we have all the turf takeoff and the snow takeoff and all the different square footage for the sidewalks, right? When we brought that down to our actual bid and estimate here in LMM, you can start to see that Element starts kicking out what we need to charge for a base plow, what we need to charge for a bulk salt visit, what we need to charge for 3 bags of ice melt to put down, so on and so forth, right? And so you can see 3 bags put down, $12.50 a cost. We charge market rate on this one for $35 a bag applied, shows our net, so on and so forth. Well, long story short, to hit the blend of gross profit and net profit that we wanted to make in Brian's Law Maintenance with our snow accounts, the account basically came up to like $8,900 and what was it, $75. And I think this is actually before I adjusted it down before I sent it off, because it was like 9.2. And 8,975 sounds a little bit more palatable, right? Well, we submitted it for just under $9,000, and the guy came back and said, well, hey, this looks good. And I'd actually show you the email exchange. It was kind of funny, but we get on the phone because he said, hey, like, we got to work on the price a little bit. And instead of having an email exchange back and forth, I just said, hey, you got a quick minute to talk? Let's talk. Because my mindset is, I would love to know why. Like, why do you think the price should be better? So I didn't say that, of course. We got on the phone, put on my best smiley face, my people skills, and let's just say his name is John. I said, hey, John, hope all's well. Obviously, you're looking at the quote. Hopefully, you're at the office. He said, yep, I am. I have it in front of me. He goes, hey, like, that's a big number. I said, well, that's what it's going to cost to take care of the not only the drive, the sidewalk shoveling, the bulk salt, and the ice melt. That's pretty much our number for the service that you're looking for. In fact, I even did you a solid because we have a couple sites nearby. I was actually able to chisel that price down just a little bit to take care of you. And he said, well, it looks good, but yeah, I'm just not sure if I'm ready to sign up just yet. Now, again, in this example, I would say respectfully, like, he needs us. We don't need him. We stopped selling snow end of September because our route was full. Now, we always leave a little capacity for anybody else that wants to come on board, and we can get them at a quote-unquote retail rate. And he clearly went with a different contractor or provider, perhaps like a low-bid guy that wasn't delivering. And so I said to myself, well, in my brain, all the chips are in my hand, and all the ball is right now in my court. And so I said, well, John, I don't know why you would be led to believe that, but long story short, this is the best price that I can do. And he said, well, I'm trying to work on this number a little bit more to make it more palatable. Can you help me out? And, here's the thing. If you're not willing to walk away from a deal, you shouldn't be at the negotiating table. And a lot of you guys have heard that. A lot of you guys have said that. But it really is a go to guns kind of a moment in the nicest way possible. And again, short story long, I told the gentleman, hey, John, honestly, like, I've done the best I can with my numbers because I do truly know my numbers with my estimates, with my budget, and with my pricing. And here's the deal. If I start bringing that number down, a couple things are going to happen. Number one, we're not going to make the profit that we need to make. And that's not going to be able to give the bonuses, the payroll, the future shop that we want to buy that maybe we're stocking some cash away for. It's not going to give me the profit I want to make out of the company in general, that maybe I want to take some chips off the table to take care and provide for my family. Maybe I promised my wife a new car or a trip to Disney. Well, if I'm going to shave my pricing down and my profit down, then it's going to come out of the company's obviously general profit, and I'm not going to be compensated fairly for what we're doing. So I'm discounting my services. And if we continue to discount our price and discount our services too much, then the quality of our work is going to suffer as well. The type of equipment that we can buy, and of course, the type of people that we can hire and invest into, not only for their wage, but for additional training, right? And so by charging a fair price, having great profit, we're able to make those investments back in the business. And in the end, who wins the most? The customer, because they get the best products, they get the best service, they get the best team on site for their property. So you're actually doing yourself and your customer a disservice by discounting too heavily. Now, again, we know our pricing for our labor, we know our pricing for our equipment, we know our pricing for our materials. And so I wasn't willing to budge because I wasn't going to be giving up any net profit on the site, especially as it was an emergency walk-in customer through the front door. Now, do I want to work with some folks once in a while, and will I shave some net off the account and, you know, sharpen the pencil a little bit? Sure. In this example, I didn't see the need to, because all the cards, again, were in our hand. And again, I'm not trying to be a butt. I'm just saying this was the reality of it. Now, all that being said, once we knew what to charge and we gave him his number and he said, well, I just want the number to work down better, I said, based on what? Is almost in a way that I was thinking it in my brain. Now, I packaged it with some people skills and I said, hey, John, to be honest with you, this is the best price that I can do, especially with the circumstances. I'm not entirely sure what happened to the last guy. And again, here's the idea. Pain and pleasure, pain and pleasure. People buy or to avoid pain and pleasure. He wasn't looking to find pleasure in buying $8,000, $9,000 worth of snow service. He was avoiding the pain of not having his lanes opened up and his car wash bay open and a safe working conditions for his employees and his customers. And so I said, hey, John, we already tried this once going with the guy that was clearly cheaper, and you kind of saw the results that you get out of that. I know we're going to be a couple of bucks more, no doubt about it. But with us, we're the one-stop shop. You call us for lawn or snow, we're going to take care of you. And the price is the price, my friend. And I said, once you go with us at this price, you're never going to have to worry about quality ever again. All right. And as they say, it's a lot easier to explain price once than quality forever if you are the low ball bid guy. Okay. And so all that being said, where did I get the confidence to know that, hey, John, you can shave us down on a couple points? Well, I can't do that because my budget tells me I'm not able to do that. I have to hit these numbers to hit the overhead recovery, pay for all the equipment, pay for all the guys, hit our sales number, ideally hit our net profit number, and do whatever we're going to do with that profit forward. Either take some chips off the table or reinvest it into the business for some future growth. All right. I know this sounds very, very simplified. It really, truly is. At the end of the day, it's a mindset before it's a strategy. But when folks try to whittle you down or they try to talk you down, and they just arbitrarily believe or think that your guys' services or your time should be at a discounted rate or cost less, or they don't make as much money as you and they have a 4-year degree or they're highly educated and, you know, their lawn guy is making $75 an hour, you know, that kind of a deal. We've all felt that. We've all felt that. And I know exactly how that feels, that you guys are sometimes dealing with that as well, just like I am, even still today. But the long story short is, stand your ground, be confident, put your chest out, roll your shoulders back. And when you submit that price, just know that if they go with you, they're going to be happy that they went with somebody who cares and is going to do the best job possible. All right. That's where I'm going to leave you guys today. That was my quick 15 or 17 minutes here. Appreciate all of you guys listening in. Appreciate all you guys watching in. I'd love to hear your thoughts in the comments. Has any of this topic related to you guys? I'm going to be watching this real time and answering those questions while I'm out plowing snow with all of you guys here today. But that's what I got for this quick recording. And again, can't thank Carla and Joseph enough for the time and the effort that they're putting into this 2-day virtual summit. And again, congrats to all of you guys for making the time to invest into yourself and your education so you guys can go on out there and not only finish Q4 strong, but have 2026 be your best year ever. All right. I hope you guys get a lot from the rest of the speakers here today and tomorrow. Love you guys. If you ever want to follow along, Brian's Law Maintenance on Instagram, Brian's Law Maintenance on YouTube, Fullerton Unfiltered podcast, and LaunchpreneurAcademy.com for our training resources. Love you guys. Appreciate you. Have a great day and look forward to catching up with all of you guys here on the next one. Back to Carla and Joseph.
I don't know if Brian sleeps. I messaged him, I think, about this webinar around midnight, and like he was saying, he was just snow plowing. So, you know, really appreciate him taking the time to present and share all that wisdom with us, and couldn't think of someone better to close out the webinar series. And, you know, really hope that everyone got value from this. Like I said in the beginning, you know, Carl and I's goal with this was to really dive into some of the specific things and really help drive change within your companies. So it's, you know, whether it's watching some of the YouTube channels and, you know, looking at what's going on in certain Instagram pages of a lot of the speakers or reaching out to them, they don't bite, you know, and so I would definitely recommend reaching out to, you know, the speakers. And like I said yesterday, I mean, even even with our accounting firm, I'm always trying to reach out to professionals that are doing past what I've done, so I can learn from them, or different resources, things that, because I'm working on the core operations of the firm, that I don't have the time to look into, right? Whether it's some of the overhead items, different things like that. So I definitely recommend to reaching out to the speakers, especially this time of year as you're planning for next year. And, it was great to see a lot of familiar, names in the chat, and, already looking forward to next year's event. And if you have any feedback, please reach out. Always looking to improve on these events as well. And stay tuned. I'm sure we'll have another webinar coming up here in the next month or two. But again, really appreciate everybody here for taking the time out, and hope everybody has a phenomenal start to 2026, and happy holidays as well. Talk soon.